Hello, hello, hello. Anybody home?
Greetings.
Hi, Mario. How are you today?
I'm doing good. How
Good.
about
That's
yourself?
just fine. Can't believe it's the last class already.
This is powerful.
Wow, how time flies. Next week, you guys will be writing your final and going off to plan what's next. Just like that. If you're planning to do accounting too, I suggest you do it whenever they offer it while this stuff is swirling around in your mind. Okay, let's give the others a few more moments and then we'll begin. All right, let's get started. I guess the others will join us when they join us. Okay, Vanessa. Not there yet. Hadis. Hadis, are you there?
Yes, sir. I'm here. Good evening, guys.
Hi, good evening, good evening. Okay. Who's next? Clinton. Mhm. Clinton was sneaking in. Mario, I know is here.
This is true.
See? Okay. Tanya, I don't see yet. Crystal, I don't see yet. Blaine.
Good night, I'm here.
Hi, Blaine. Okay. Denise.
Good night.
Hi, Denise. Okay. I don't see Havanique yet. And
Yes, you're
Chanel.
back.
Crystal, there you are.
Yes, sir.
Okay, let me just make sure I mark you here. Crystal. Okay, good evening, everybody. Welcome to our final regular class. Next week when we meet again. Does anybody remember which day we agreed on?
Tuesday.
Tuesday at 6 o'clock. Head on down to the same place you went the last time and do the same thing you did the last time. The only thing you're allowed to do differently is to do better on your final. Other than that, everything else is pretty much the same. Okay. Any questions before we get started with our final discussion for today?
So boom, right?
Mhm.
I don't know if it feels okay, boom. So it feels like the computation of a ratio is familiar, but I'm a bit confused when it comes to computing the inventory turnover. Now that could very well be because I haven't practiced it enough. But in doing so, or in thinking about doing so, I think the existence of the different costing methods
Right?
is like sort of like spinning me off, because it's almost like when I'm looking at the data, when you create the tables with the data for the different average cost method and life in, no, not sorry, not life in, LIFO and FIFO, whatever, woo, woo, woo. When you have to compute the average inventory over cost of goods sold, I would know how to get the cost of goods sold from each of those different methods. But when it comes to computing the average, is that average taken from like all of the units added and then all of the different prices added, and then you take the average of those and then you use that figure? Is that figure the one used in the computation of that ratio, or it's something different?
Now, let's make sure we're talking about the same things. When we talk about using the weighted average method for inventory costing, that is different from the expression you just said about inventory turnover.
Okay.
Where did you see inventory turnover to begin with? Where did you see that expression?
I feel like we may have seen it, maybe chapter 1 or 2, maybe 3, but I know it
Right.
came up again in chapter 7.
Now, when it came up in chapter 7, did they give you a formula?
They did. They said total cost of goods sold over average inventory.
Right. And that particular ratio is very different from calculating using the weighted average method for determining the cost of inventory.
Okay.
Okay, so the key is to make sure you keep them separate, even though they both have the big time word inventory in them.
Yes.
Okay, they both have two different methods for calculation, so make sure, you remember under weighted average, you only calculate the average price every time you make a purchase. And then you use that average price going forward until you make another purchase. So that's how we apply the weighted average method for costing inventory. Inventory turnover, on the other hand, is completely different ratio, and it has its own formula. And its own formula, as you said, is cost of goods sold divided by average inventory. Now, average inventory usually has a standard formula as the denominator. Average inventory is usually beginning inventory plus ending inventory divided by 2.
Okay.
Okay, absolutely, and that's it. Nothing is not connected to using the weighted average inventory costing for under FIFO life and weighted average. Okay,
Let's save me some points.
yeah, and hopefully some confusion in terms of the difference between the two. Okay?
Alrighty.
Oh, for sure. Okay. Remember, inventory turnover ratio is designed to let management know how quickly and how often the inventory that they purchase is actually sold. Okay, so we buy inventory and it turns over and the ratio is 1, that's not good for the whole year. But if it turns over 5 times, then you know that that product is really moving. Okay, and that's really the purpose of that particular ratio. But they certainly have their own separate ways to go for sure. All right. So if you, let me just put my thing on the screen in case somebody wants to look on along with the textbook. Share screen. Okay, there we go. We were talking about this in receivables analysis, age analysis. And I think we got all the way down finally to the totals for each category. If you notice, if we add all of the different columns, other than the total column, they should equal the total column. If they don't equal the total column, you've done something wrong, for sure. Okay, so once we determine what's not due yet, what's 1 to 30, 31 to 60, etc., then the next thing to do in this age report is to determine the percentage of uncollectible accounts. And as you can see, for each column, we have an estimated percentage of uncollectible accounts. What percentage is deemed to be uncollectible 90 days and over? Anyone?
Does that say,
Sorry?
does that say 50%?
Yeah,
I'm reading that.
50%. Why do you think it's so high?
Because if the people didn't pay in 3 months, then they probably may not pay at all.
Indeed. And in this case, it is presumed that if they pay at all, only about half of them will pay. And of course, this is based on experience, trends, estimates. Okay.
So boom, right?
Sorry?
Good question. Like, in an instance where someone comes to pay, like, let's say it's like 5 months later, right? What has
Right.
happened? Like, do they like reopen that personal customer account for them? Or they just like send it straight to revenues on sales or something?
Yeah, good question. If the account is written off already to bad debt, and then the person comes in the following month and say, I won the lottery and had to pay off my balance, we don't reopen it. We credit other revenues with whatever the amount of money is. Okay? That's
Right.
how we do it once the account is written off. Of course, if the account is not written off, then the credit accounts receivable as usual and debit cash for whatever the
So
payment.
basically, okay. So basically, the typical time to write off an account is 3 months.
Average.
Okay.
Average for most companies. Some companies might go to 6 months before they write it off. Or depending on the facility, the loan, the situation, they might go to 9 months to a year before they write it off. But on average, it's 3 months to 6 months to 1 year, depending on what's going on. But those companies that don't discuss, and most companies don't discuss too much past 6 months. And there are some that only tolerate 3 months. Okay? So yeah, it depends on the entity and it depends on the nature of the facility. All right, so we have our estimates. Do these collectible percentages equal 100%?
No, they do not. They don't.
50 plus 30 is 80, 90. No, they don't. Should they equal 100%?
I don't know. Should they?
No, they don't. They don't have to equal 100%. All you're doing is estimating what percentage of each category of outstanding accounts you feel you will not collect. So there's no rule that says they should equal 100%. Okay.
And like that percentage that they put there, percentage loss ratio, that's not computed based off the data they have for that specific year. Like you said, that's just like an estimate that they chose based off experience in previous years.
You mean the percentage amounts?
Yeah.
Yes.
Oh,
Right.
okay.
And every company has its own way of determining those percentages. Okay, for sure. Because every entity is different and their portfolios are different. Right? All right. So in the case of not yet due, how much goes to the allowance for uncollectible accounts for not yet due based on that percentage?
1%.
1% or how much in dollars?
You're Oh, $438.
$438. And we do the same across the board for each column. Okay, and when we're done and we add them up, it should equal the 4918 that is sitting in the totals column for the allowance for uncollectible accounts. So in this particular period, we're saying we're making an allowance for $4,918 broken down as we see them in this particular schedule. And this is very important information for management because not only they get to see how much is being allowed in total, but they can see what allowances are being made in what categories. And perhaps as a result, decide on taking some other approaches, okay, to trying to collect the outstanding amounts. Remember, in as much as the balance for some companies might be 4,918, for others it could be 4,918,000. Okay, so it all depends. All right, so that is your age receivable account schedule. Nowadays, it goes into a computer. You just have to make sure the amounts you put in are correct so the computer can spit out the correct amounts. Because remember, as usual, computers are swift, they're consistent, but they're dumb. They can only do as much as we tell them to do and with the level of accuracy of the data that we put into them. For sure. All right. So notice the journal entry in this particular instance. And perhaps we may want to take a look at this particular scenario because remember when we did our allowance earlier, we had X amount, and now we have a change in the allowance balance, as you can see. Notice the 4918 that we estimated in the aged receivables is actually made up of two individual amounts. Anybody see it?
I do.
What makes up the 4918 in the general ledger? And
That would be the other than. Oh, well, that would be the uncollectible accounts expense.
okay, and which amounts make up the 4918?
The 3,318, as well as 1,600, but like, where's that coming from?
Yeah, where's the 3318 coming from? Because so
From-
far, we only saw the 4918.
I'm assuming that's from the previous year.
Well, let's see. Well, why would you assume that? Did you see that from the previous year? You're just making that assumption.
I'm making that assumption, but I don't think it's quite logical because it says December 31st for both, but it doesn't say a year.
No, it doesn't. Okay, so let's right under the age receivables chart, there's a little narrative. Why don't we read that narrative real quick? You see what it says in the first case. Does everybody see that? In the first case?
Yes, sir.
Yeah, in the first case, an adjustment of 3318 is needed. See? Now all of a sudden we have a set of rules that govern what we do. So we have the age receivables that we see in the schedule, and we see that together for each of the columns and each of the periods outstanding, they total 4918. However, that 4918 is made up of two amounts. So how do we arrive at those two amounts? Well, we are told that in the first case, an adjustment of 3318 is needed to bring the balance of the allowance account to 4918. Now, if you don't take a moment to read that, dog eat your lunch forever, as far as this process is concerned. Okay? Just like when you don't read the instructions for doing something and you try to do without the instructions, and then all hell breaks loose, and then we wonder like maybe God hates us after all. When in fact, All we should have done was read the instructions. All right. So how do we make that question?
The ones that I think you're supposed to walk us into it, but this $1,600 is the current balance that they want to allow for the uncollectible accounts.
Not only is it the current balance, but it is also, it seems to me, that amount that you were talking about that was brought forward, so to speak, to
What do
become
you
the
mean?
current balance. So if it's the current balance, where did it come from?
From last year, from
Yeah,
last
from the
period.
previous period, yeah, from the previous period.
So the
Absolutely.
the 3318 is the uncollectible.
Yes.
Okay, because there's the both of them total of what the 4918.
Yeah, the 3318 is the actual amount uncollectible. Okay, the 4918 is the targeted balance based on the age receivable. But the actual uncollectible is the targeted balance minus the current allowance, which gives us the actual uncollectible expense. Kind of like a little formula, a little rule, like all the other little rules that we have. Okay, with regards to uncollectible accounts and allowances. Okay, so once we find out what the actual uncollectible amount is, that is the one, that is the amount that we prepare the journal entry for, because that is the amount that we want to show in the what? Current income statement as uncollectible accounts expense, debit. Everybody see that?
Yes.
And then of course we credit the allowance account, allowance for uncollectible accounts for 3318. And when we debit that to the allowance account, that is then added to the 1600 for a total targeted uncollectible of 4,918. In other words, as at now, the allowance for uncollectible account is made up of last year's and the current uncollectible amount. Total 4,918. Uncollectible accounts expense for this year, 3,318. Debit. Okay, it's not difficult once you follow that rule, actually. Now, something else interesting is going on. Look right under that first journal entry. So that part of it is pretty clear, but it looks now like they're trying to muddy the water a little bit. Note that the resulting balance of allowance on uncollectible account is 4,918, which is the targeted amount that we estimated in our aged receivables. No problem. In the second case, because allowance for uncollectible accounts has a debit balance, in the first case, it had a credit balance, and whenever there's a credit balance, this is the process that we use here. But if uncollectible accounts has a debit balance, there's another process that we use. Has anybody figured it out?
You add the 1,600 instead of, I guess you add it twice?
Well, you don't add it twice, but you add it instead of what?
Subtracted.
Correct. Okay. And that's just the rule of applying the allowance method. Okay. If the allowance account has a credit balance, we subtract it from the target, as we did here, to come up with the current uncollectible. And if it has a debit balance, we add it to the target to come up with the current uncollectible. And again, once you do that, we do our usual journal entry and everybody's happy. Except when we get over to the allowance account, something interesting happens. What happens in the allowance account?
It drops it back down to 419 because it had an original debit balance instead of credit.
Indeed. In other words, at the end of the day, we still end up with the targeted balance of what? 4,918. We only go through all this tap dancing depending on whether the allowance account currently has a what? Debit balance or credit balance. See? And if you just look at it that way, don't add anything, don't subtract, don't overthink it, you'll be fine. Okay? All you ask yourself is if you have a situation like this, does the allowance account have a credit balance? Answer yes, then subtract it from the target. Make your journal entry for the current amount. That's it. Or does the allowance account have a debit balance? Yes, then add it to the target. Do your journal entry, post it, and you're home free. Rules, rules, rules. And once you apply them, did you guys heard about the Bahamian that was killed in Connecticut?
We're two, eh?
The other one died?
That's what I thought they were saying. I don't know. I thought they said that both of them died. I don't know.
No, one died at the scene, the 21-year-old student,
Mhm.
and the other one is in hospital, they say, with 75% burns on his body.
Wow.
They hit a tree. What do you think they were doing?
High, drunk. I don't know. Flying.
All of the above, speeding, high,
Mhm.
drunk, speeding, all of the above. Maybe not high or drunk, just speeding, lost control. What amazes me is young people see other young people crashing all the time from speed and they still wouldn't slow down. Because somehow they always presume it'll be the other person. Kind of a presumption to make. My son Dante just got his license in Canada a couple of months ago. He doesn't have a car yet, thank God. But soon, eventually, he will have one. And one of the things I keep saying to him, remember, when you get a car of your own, try to resist speeding. Because if something happens at high speed, you have no control over the vehicle. You just wait to see what happens to you and the rest of you. That is an unfortunate truth. And that is an unfortunate situation. 21 years old, just starting his life. Like Mario, imagine that.
I am just kind of in awe. I don't know if that's the right word to use, but it's kind of tough. It's kind of tough.
Things, actually. Okay? Accidents happen, but some of them we could avoid sometimes. And that perhaps, again, was one of them. Wow, it's unfortunate. All right. Just thought I'd throw that in when you get behind the wheel. Writing off of uncollectible accounts, I think we started to have that conversation. It's just a matter now of determining the journal entry for writing off an uncollectible account. Has anybody figured it out yet? How to write off an uncollectible account?
You just close it off. You just do a little journal entry.
Okay, well, in this example, how much are we writing off?
500.
500. What do we debit?
We debit allowance for uncollectible accounts.
Okay, because again, we're using the allowance method. And what do we credit?
Accounts receivable for T Vigo,
Why?
because we want to decrease his account or empty it out.
Which one?
The accounts receivable.
Are we decreasing it or emptying it out as you put it?
Emptying it out.
What does emptying it out mean?
Decrease.
No.
Close.
Close. Bring it to zero. See, decrease is this. You owed 500, you paid 200, you still have 300. That's decrease. Write off. Once you credit accounts receivable for the full amount, the balance is zero. That's the difference.
Okay, so I have a question, right?
Mm-hmm.
I'm like, excuse me if this sounds dumb,
No
but
such thing in this class.
from what you taught us, right? When you can you
Uh-huh.
scroll back up just a little bit?
Sure.
Okay, from what you taught us, right? When you
Mhm.
oh, never mind. I'm mixing it up. I was mixing up accounts receivable with a regular credit account because I was going to say you credited it, which means you're increasing it. But accounts receivable has the normal debit balance. So if you credit it, I mean you decrease it. And if you credit it for the amount it should be in allowance, then you're writing it off as you just said. So never mind.
Absolutely. Absolutely. Now, in this case, we're using the allowance method. Somebody in this class might remember what the other method is called. Does anybody remember? The one other,
Reversing entries.
the other one other than the allowance account.
Think of you're talking about like closing accounts, right?
Writing off accounts.
Yeah, I guess not.
There are two methods for writing off accounts. One is the allowance method, and the other one is the direct write-off. Anybody else saw that? The direct write-off method.
No,
No.
not yet at least.
Okay, so you guys still have some exciting things to run into before it's all over. That's the other method for writing off accounts. Okay. Notice the write-off of $500 doesn't affect the net realizable value of accounts receivable before the write-off and after it's the same because the allowance amount is the same, doesn't change. That write-off only gets rid of that particular account that you don't believe is collectible, but it doesn't impact the allowance account that has already been determined, which is the 4918. Okay. Crazy thing about accounting, once you keep things in a certain perspective, it makes life a whole lot easier. The other thing about accounting is if you stop losing perspective and start trying to do your own little thing, things start to get weird every single time. Okay. It's like that allowance account. If it has a credit balance, what do? Do you add it or subtract it from the targeted amount? Anybody remembers?
If it doesn't what?
If the allowance account has a credit balance, do you add or subtract it to the targeted amount?
Subtractive.
And if it's a debit balance,
You add.
and whatever results you get, what do we refer to that result as?
The actual uncollectible amount, allowance amount
For which period?
for the current period.
Man, see that? The rules. Following the rules. Here you just cruise through that, the rules. And you didn't do anything extraordinary. All you did was follow the rules that we discussed. It made you look like a genius. Welcome to following the rules. As you can see, accounting has a lot of rules. It's very rules-based. Every now and then we allow you to use your opinion, your stomach, your gut, but not too often. Okay? Economists use their gut, and other lawyers use their gut, and a bunch of legal mumbo jumbo tie things up. But accountants don't use too much gut nor mumbo jumbo. We use a set of rules for the most part. Every now and then we get to estimate, but not too often. And in accounting, once the rules are set, they pretty much remain the same for all practicing persons. Nobody's allowed to step out with their opinion unless they're allowed to do an estimate occasionally, like the estimated useful life of an asset. And even that you cannot just pull out of your hat. You have to look at the asset and say, based on the type of asset, what is the estimated time that that is going to be performing well? You still don't get to say in my gut. You still have to use some reasonable point of reference. We don't do the gut thing much. All right. So then we're down to the last part of this chapter. The notes receivable is a promissory note. Bankers would be familiar with the term promissory note. When you go to the bank and sign a promissory note, you're telling the bank that you swear you will pay the amount you borrowed plus interest on the due date that they say, or you agree to pay until the entire loan is paid in full. Whenever, and in the business world, whenever a notes receivable arises, somebody owes you money. Whenever a notes payable arises, you owe somebody money. It's a liability. Okay? It's pretty much the difference between note receivable and note payable. In financial services, when you get a bank loan, we don't call it notes receivable. Sometimes some people might call it that depending on the terms and conditions of the deal, but we tend to call it a promissory note depending on the type of loan you're getting. Okay? But in business practice, we have a note receivable, everybody signs off. It's filled in pretty much like a promissory note, no date, amount, interest rate, no, that principal, that kind of stuff. And everybody signs off happily, promising to pay everything they say they would pay. Okay? If you look at this example of a promissory note, for those of you who ever borrowed money from the bank, it may not look like this, but it's this. Okay, the amount, the date, your promissory note at the top, the bank that you're borrowing the money from, words and figures, everybody signs off, not everybody, you sign off. To say you swear, you'll pay it back. But from what we can see earlier in the allowance account, not everybody pays back. Most of us do. But we always have a small gang who does not. Okay? All right, now I don't know if you guys have studied the maturity date yet in your text. I mean, when I say study, I mean read it. But it's very important when we have outstanding notes that are due for payment that the maturity date is accurate. Because sometimes one single date difference can result in thousands of dollars over or underpaid. One single day difference, depending on the amount of that particular facility. So when we look at defining maturity date, we are told that this is the date on which a promissory note must be paid. This date must be stated on the note or be determinable from the facts stated on the note. And they give us a nice, clean example. The first one is a specific date. The other one is based on the number of months after the date. Like 3 months after November 11th would be when? Anyone? If it's based on months, 3 months after the date of the note, that would be, and the date of the note is November 14th. What would be 3 months later?
Valentine's Day.
Which day?
Valentine's Day.
Would it be November, December, January,
Oh,
February?
February 14th.
Yeah, that's Valentine's Day.
2012.
isn't it?
Yeah, it is.
People. All right. And then number 3, a specific number of days after the date of the note, such as 60 days after the date of the note. So any of these 3 conditions can exist in the signing of a promissory note. Whichever it is, make sure you're clear, because being off one day can create a problem. Okay. Now look at the example that is, I'm sure you have one of like this in your text. So look at this example. Right here at the bottom, it says when the maturity date is a specific number of days from the date of the note. However, the exact maturity date must be determined. In computing the maturity date, it is important to exclude the date of the note. Anybody knows why? Why would we exclude the date of the note? Anyone?
Because it starts after the note was issued. It starts on the day after the note was issued,
Yeah,
rather
it
than
always starts on the date after the date of the note is the negotiating date. A lot of people like to start with that date in practice. But in practice, you're told another rule, do not include the date of the note. Students, I mean, I've given tons of examinations, just throw that in for the record to see if folks are going to include the date of the note. And there's always a little small gang who still includes the date of the note. Okay? So in this example, the note is dated May the 20th and it's due in 90 days. People always get stuck. Well, we are told 90 days from that particular transaction would be August the 18th. Well, let's see if that's true. Ah, should we start with May the 20th? Does the textbook start with May the 20th?
I wouldn't even know what page that is.
Or you can look at my screen. It'll be
Yeah,
the same
okay.
principle.
What's your question?
Does the text here start at May the 20th?
It says so.
Number of days. It says so.
Uh-huh.
Okay. But according to the rule, should we start with the date of the note?
No, we should start on the day after. So the day will be May 21st.
So from the 21st to the 31st, is that 10 or 11 days?
11? 10.
10?
Yeah. May 21st to May 31st, that's 10.
So why do we have 11 here?
Because they started on the day that it was issued.
So we move away from the rule then.
I'm so confused what's happening. Isn't the issue date May 20th?
Yes.
You
Isn't
just
that
tell us.
Yeah, isn't that interesting?
You just tell us say in practice you start after.
Well,
But they say
that's what they tell us too. If you look in that paragraph, it says when the maturity date is a specific number of days from the date of the note, the exact maturity date must be determined. In computing the maturity date, it is important to exclude the date of the note.
so either they exclude the date of the note or I misinterpreted or miscalculated.
Well, it's interesting here because they actually started with the 20th. Does that mean the 20th is not the date of the note? Or the 20th is the date, is the first day after the negotiated date, which is the 19th? What is it? We don't know. Because according to the information we have, a note dated May 20th means that May 20th should be excluded, shouldn't it?
Yeah, so that means it was May 19th because they clearly just say he's exclude the issue date. So if they start on May 20th, that means that the day, not the day, the note was issued on the 19th.
Yeah, we have to assume that the note was negotiated on the 19th. That's the only thing that makes sense given this situation. Okay? How many days in June?
30?
30 days. So that's 30, 41 so far. How many days in July?
31.
31. So 11 plus 30 plus 31 equals how much?
72.
And 72 from 90 is equal to
18.
18. Hence, in August, the promissory note date is August the 18th. 90 days, exactly 90 days later. Hopefully everybody got that.
Okay, Mr. Wilkinson, what is the, okay, we're saying here in this paragraph, the maturity date is obvious when a specific date is stated. Trying to understand based on that confusion earlier when you said we should start after the note date, but in this instance, we're using the note date, the 20th. I got confused.
Yeah,
Is this calculation right then, or what are we saying here?
yeah. What we're saying is if they're starting with the 20th of May, then it means that the note was actually negotiated on the 19th with the actual note date being the 20th of the month. But it was actually negotiated the previous day. That's the only thing that makes sense. according
So-
to the information they have here.
So question,
Mhm.
in an example where the note is dated on the 19th and we start on the 20th, what would the question say? I want to know how they would word it, because looking at this, you could also assume that the note, it says a note dated May 20th. So you could also start from the 21st. So how would an example be if it was dated actually on the day that it was negotiated?
Uh-huh. Now, I was hoping that somebody would have started getting warm before now. And because of your query, you have made it warm now. And it inadvertently challenges Mario's presumption that it would have been the 19th, even though they did not say the 19th. And it also challenges Mario's counting abilities in terms of number of days. Mario said from the 21st to the 31st is 10 days. Is that really true?
The
Based
31st, the 21st to the 31st?
Yes.
That's 10 days, eh?
Count it on your fingers, see if it's 10 days. Yeah, Mario. It might be. I know it feels like count on your fingers, but you might be surprised though it counts up on your fingers.
That's 10
Not 10
days.
days.
That's 10 days?
No.
Aha, somebody said, hell no. I wonder how come. Some of our fingers must be different from somebody else's fingers.
So 31 minus 21 ain't it?
Well, somebody said, no, start using your fingers. Start licking
Wait,
fingers.
hold on.
Why we
Hold on,
minusing
hold on, hold on.
21? Why we minusing 21, not adding 21? It's starting from 21, right? 21,
Because
2,
the no date is
not
20th.
22. We're not minusing, we're saying from the date, which is the 21st.
Right. And if you count from the 21st to the 31st on your finger, that might not give you 10.
Okay, enough with the guessing. I mean, let's just figure this out. Like, cause we
The-
could guess
the-
till
the
Jesus
thing is-
reach.
Okay,
Like-
well, no, just start with the 21st with your finger. 21st, 1, 2, 3, 4, 5, 6, 7, 8, 9, 30th, 31st. That's 11 days. It's no secret. Do it. Nobody wants to do it on your finger. As long as you don't do it on your finger, you're gonna be stuck. Do it on your fingers, just as I said, starting with the 21st. Because the 20th is the no date. It's funny.
It's 11, yeah, it's still
Yeah,
11.
it's 11.
Like, I'm trying to understand why we confused with counting. You only want to pull up the fingers, say, what happened?
Oh,
Yeah.
so
when all else fails, start licking fingers. Count with your fingers.
watch
No
this,
change
right?
with me getting to say, I can need that, I count them fingers.
I think I
be
just learned this
sure.
trick.
Cause see, if you say 31 minus 21, using your calculator in your head, you're gonna get 10, right?
Ah. So basically, right?
Really?
When
You have
when
something
are
else
you
to add to this?
watch this? I just learned a trick.
I'm
I
watching.
can't remember the name of the person who was wrong with me, but this is the trick, right? So boom. When you are statistically computing the amount of days based off numbers in front of you, in other words, data, you do the regular calculating, you do the regular calculator command, and then add 1.
Fine.
So on the calculator, when you take May 31st, or when you take 31, which would be May 31st, and minus that from 20, which would be May 20th, you're gonna get, sorry, that's not what I was saying. When you take when you take 31, which would be May 31st, and minus that from 21, which would be May 21st, you're gonna get 10. But
Right.
that's from a data perspective, an intangible data perspective. But when you
Right.
do the practical days in real life, you gotta add 1.
Yes.
Mario, I wouldn't say get
Add
stuck
one.
with that.
I know.
Go ahead of the class, Mario. Go ahead of the
I'm
class.
serious,
No,
because these due
man.
dates could be so tricky. You have to be careful, because
In
then
other
it
words-
doesn't have to be the 21st. It could be
No,
a
yeah.
12-day period.
In other words, here's what you do. For the first month, whatever the payment date is, whatever the date of the note is for the first month, you ignore that day and start counting on your fingers with the next day. Whatever it is, until you get to the end of that month. Then you can start saying 30 days has September, April, June, and all that stuff. Truly amazing how the same old thing from grade 4 or 5. Here we are, grade 6 stuff. But again, it's just a matter of following the rules. That's it. Okay?
Right? This means when the people calculating the maturity date, they sit down and count on their fingers.
Probably not. But
They have a
Mario,
calendar.
that's negative, Mario. You have a lot of other things to do
Probably
besides
some
counting.
They have a
people-
calendar.
some
Right.
people use a calendar. Some people use your +1 thing because they think they figured it out that way. And others just count on their fingers. Just it depends on who it is. And
So,
other people just do the 31 minus 21 and get it wrong.
so in essence, I still trying to figure out, because in the exam, this could go either way. I still trying to figure out if they want us to calculate from the day after. How would they word that?
No, here's what's gonna be. They're gonna say, you have a 90-day note
Mhm.
and the date of the note is May the 20th or June the 13th, whatever day the note is. If it's
So I would-
if
go
the
ahead.
note is June the 13th, then you
Mhm.
start counting from which day
The 14th,
and end on which day in June.
30 days, so June, so on the 30th.
Absolutely. Then you keep adding full months until you approach the 90 days. Whatever the difference is, like in this case, 18, that will be the difference for the last month you're in.
Oh, okay.
Yeah, I know. Even though it's simple, it's still tricky for some people until they get used to it. Okay, for sure. All right. By the way, while I remember, did I get all my homework back from everybody?
What homework you're concerned? This the old one, eh?
I didn't assign homework to you guys?
Y'all get homework? Like recently, are you talking about, or this the homework?
About
with-
2 weeks ago, right?
Oh.
Yeah,
you
2
scaring
weeks
me.
ago, like homework number 2.
Yeah.
Oh, scaring me. Yeah, okay.
Okay.
That was like the makeup, right? Oh, that's something
No,
totally
not the
different.
makeup. Homework
We had
number 2.
two. We had homework and makeup.
Yeah, homework and makeup. So if you still haven't finished your homework number 2, you still have time to send it in. Okay? All right, so that's how we calculate maturity dates. If you found it a little weird at the beginning, you're not alone. Even in practice, people make the same mistake. For example, in this one we looked at, they'll say, the note date is 20th, so that's the 21 to the 31st. 31 minus 21 is 10. And they go on with that. And they set the whole thing up based on that. Okay, for sure. So their maturity date will not be August the 18th, but rather August the 19th. It's only a couple of bucks, fine. But what happens if it's $1 million because you paid a day late? Okay, interesting. All right. What about this duration of a note? What's that? Is that the same as the previous one? The duration of the note is the time between a promissory note's issue date and its maturity date. So in this example, What is the issue date? What's the issue date in this example? It's right to the bottom of the
Isn't it the
paragraph.
19th? Bottom of the paragraph.
No, the bottom of the paragraph, under duration of a note, just before the end of that paragraph, they give you the issue date.
May 10th.
Yeah. The issue date is May the 10th. When does it mature?
August 10th.
August 10th. And therefore, the question will be, what is the duration of this note? And you have to calculate the duration. How long will this note be outstanding before maturity? So you have the issue date and you have the maturity date. Now you have to calculate how many days does that represent? Well, here we go again. Do we include the note date? Do we? You guys don't believe in the rule say don't include it. Right? So how did we get 21 days? Did we say 31 minus 10? It does give us 21, doesn't it?
21 if you minus it, so,
Is that correct though, to do it that way?
no.
We cannot use, according to the rules, May the 10th. That's the note date. The rules say never use the note date. So we have to start on which day? You have to start counting on which day? May the
11th.
Yeah. From the 11th to the 31st, how many days is that?
It should be 21.
I don't know. Are you sure?
I would think so, yeah. 21. 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31. Yeah. 11. 21, sorry.
Okay. Hopefully your colleagues see it the same way, but yeah. We start counting on May the 11th, from May the 11th to the 31st. If you go to a calendar, it'll give you 21. If you count on your fingers, it'll give you 21. If you count in your head, beginning the 11, it'll give you 21. And that's how it should be done. So we have the number of days in May, 21. How many days in June?
30.
July?
31.
And when does this note expire, mature?
On the 10th of August.
So if we add 21, 30, and 31, what does that give us?
72. Sorry, 82.
82, up to the end of July. And then we need 10 more days to take us to the 10th of August, which means that the total days duration of the note would be 92 days. They're going through a lot of trouble to calculate these maturity dates. And there's a reason for that. Because if you mess those up, you can end up receiving less money than you're supposed to receive or paying out more than you should. That's why they're going through the trouble. Okay. All right. I'm going to take you back to grade 7 for a minute. Simple interest. Anybody remembers the formula for simple interest? The grade 7 teacher tried to drill it in your head and said, man, I don't want to know that. What's the principle? What's the formula for simple interest that you still need for your everyday life? If you open up a CD, they calculate simple interest. What is the formula? Do you see it on my page?
Principal times rate of interest times time
Times time
multiplied by time.
over 100. Where do you think the 100 would go?
One more
Under,
time.
under which of those three variables would the 100 be under?
Rate of interest.
Rate of interest. Why?
Because that is something where a ratio has to be computed.
Well, interest is always calculated as a percentage, isn't it?
Very true.
And percentages are always over.
100.
Yes, just like in grade 7, when you thought, like, I don't need to know this. I want to go and play. All right. So now that we know these due dates, duration dates, and simple interest formula, see? In the old days, we used to say the simple interest rate formula was PRT over 100. P for principal, R for rate over 100, and T is for time or the duration of the note. Together, all of that equals the interest that you either receive or you pay, depending on what side of the fence you are on. All right, so let's look at an example of maturity value where the principal is 1,000 and the interest is how did we calculate the interest? By the way, you'll need a calculator for next week for sure, maybe 2 in case that one doesn't work. How do we calculate the interest of $19.73 to put onto your savings account for your $1,000 that you deposit in the bank? In fact, how long is that money going to be on your account according to this example?
For 90 days,
For 90 days. What is the rate of interest?
8%.
8%. So now, if you know all of that, just calculate the formula and you should get $19.73. I don't suggest you take the books for it, you should calculate it. Just to make sure you are comfortable with it.
I got this.
Did you get 1973? Yeah? Did everybody see how we got 1973?
Yes.
It's a simple formula, but you have to be comfortable with it to get it right.
Oh, that's independence here.
Well,
Sorry.
yeah.
No. That was random, sorry.
You know what is amazing? The baby in the room recognized the independence here. How did that happen, Mario? What prompted you to remember that?
That's a year or number you hear often when you're,
Yeah, but
being
they say
weird.
young people like you don't hear a bloody thing.
well, perhaps I'm not the average young guy.
Evidently. For sure. Okay? And if you have any friends who are young like you, need to rub some of that off on them.
I try to.
Good. Good. Because in case you didn't notice, our young men are in big what?
It's in
Trouble.
this yeah.
Yes, they are. Looks like everybody's forgotten about them for some reason. People don't even make sure they learn how to read anymore. How the hell does that happen, Mario?
Well, not the children. The guys just be lazy. They
No.
don't want it themselves.
No. I was hoping you didn't say that. The guys are not lazy. Just about the average child will do anything you let them do. It's not
I think they push females to go to school more than they push males to go to school. Simple as that.
Why?
I don't
Yes,
know.
yes,
I don't know
yes,
why.
I
yes,
think
My mom,
yes.
My mom used to like she used to beat the school thing in me, so that's why I would, I mean, Bama's ain't slow, Bama's smart. We just lazy at that point in time.
No, no, see, I know what you mean. What you're talking about is the end result. See, here's what happens. If the only reason why you guys can understand what the hell is going on in this class, because somebody made sure when you were small and didn't even know who the hell you were, that you learned the fundamentals. True or false?
True. True.
Whose job is that?
Parents.
Teacher.
Parents
Ooh.
first,
Sorry.
teachers second. The two together. Simple. So, how the hell does a guy graduate from high school and can't read? Whose fault is that?
His fault.
Hell no. Hell no, it isn't.
Whose fault is that?
It's his parents and the school system.
We could,
Period.
we could debate on this now, Jesus come, Mr. We could, oh gosh.
Okay, let me turn it around then. If a girl, because many girls can't read either, how does that happen? Is it her fault too?
Well, whose fault evident? Okay, so at the end of the day, we could blame the parents, right?
We have to blame the parents.
But the average parent, which is more than 50% single mothers, have to work to take care of kids.
Listen to me, I know.
So you can't expect her to be to work and home with the kids.
No, what she has to do is when she comes from work, sits down with Johnny and make him read, no matter
And
how tired she is.
And
Drink coffee.
I agree with that. I
Yes,
agree with that. But the
Yes.
the average, on the average, I don't want to say poor, the average worker with minimum wage don't work 9 to 5, they work shift. Whether it's
Good.
hotel, whether it's these restaurants,
I
whether it's
know.
whatever.
I know.
So
I know. See, we keep coming up with a reason. I realize what you're saying. But if you work shift, find a time that is consistent for you and your child to sit down for a half an hour to make them read to you.
I
I don't
agree.
care what shift you're on.
I agree.
Okay, so if you
I
work
agree.
a night shift and you come in 6 o'clock and they're getting ready for school, when
6
they get
a.m.
up, if you come in 6 o'clock and they're getting ready for school,
Okay.
then when you wake them up, they have half an hour of reading before you get them ready for school. See,
Okay.
I am not interested in all the blah, blah, blah. I know there are all these things happening. But we see, as parents, we brought these flicking children. So whatever our agenda is, we have to make sure that they get the fundamental tools so that when they grow up, they don't have to make an excuse for our inadequacy.
I agree, completely. You and I saying the same thing, but I don't think you should say they push girls more than boys. It's just that on average, it's more girls than boys. So girls are going to do better because it's more girls.
I think girls just more receptive.
Folks, listen to me. We have pretty much an
Mr.
equal
Wilkinson,
number. No, we
Mr.
have pretty
Wilkinson,
much an equal number of men and women in the world, period.
No,
Mr.
we talking about
That's the
Bahamas.
problem.
Mr. Wilkinson,
Yes.
I give my little 5 cents. Please, nobody take no offense. But from going from my previous comment, mothers push their daughters to be more into the books than the males, and they ask the males to go do a trade. If you look, I
That's
don't know
true.
if I don't know if anybody knows that our country is ranked number 3 in the world in terms of having the most female CEOs, executives, and managements and directors. And it's very rare that you see a male other than say, the actual owner of that financial company or that particular bank in that role other than a female. So it's like I say like it's like a systematic thing because it's going to be hard for males to catch up to what females at this current time. Because if we look at majority of females, most of the females now, all of them have at least a bachelor's degree. At least most of a bachelor's degree. If we go in any in terms of any white collar job, in the Bahamas, you see a female, and you see one or two males. That's the Clinton who actually got a scholarship to go to for track or whatever to get his degree. Other than that, you're not gonna see directly a male in those situations like that. Majority of the time, you're gonna see female.
Let me just tell you guys something. Once upon a time, decades ago, before you were born,
For the war.
okay? Before you were born, the Bahamas had an equal set of men and women moving in the same direction,
Mhm.
okay? And then somewhere along the way, it shifted and we started de-emphasizing education for young men and pushing education for our young women.
No, y'all
Nothing
can't say
wrong,
that.
nothing wrong with education for women. What is wrong is when you de-emphasize education for men.
But ain't nobody doing that though. I think because of our population, women thrive more.
We have an equal number of men and women.
No, we don't. We
No,
have
we
by far way more females.
Way more females than men on this island.
By far, we have way more females.
Okie dokie.
And
Let
so
me
the
tell you
females
something.
just gonna thrive because it's more of them.
Okie dokie. So
But
let
I
me
don't
tell
think
you
they
something.
push.
Let me tell you something. Here's the other problem. I've worked in many kinds of jobs. I've sat in many kinds of meetings about who to hire. And I've seen more than my share of resumes that come up male, they put them away. They deliberately do not hire them. And what is ironic about that was, in the old days, men hired a lot of women back in the day when women were making a move, but women do not reciprocate today.
I wonder how come though.
Well, we'll find out when the stuff hits the fan somewhere in the future.
I mean, it's more costly to hire a female because you get paternity leaves, you get this, it's more costly.
No, it's
You can't. That's discrimination. You can't even think of stuff like that.
it's more to it than meets the eyes.
So
I
with
guess
you
men
saying
probably
that
not
what if
making.
that meets the eye, right? Do you think that the statement, not the statement, but the notion of there being some sort of like psychological aspect to it is relevant?
No, it has nothing to do with psychological. We have simply, for whatever reason, started de-emphasizing the development and education of the male in Western society, in particular in the Bahamas.
You don't think it have anything to do with the fact that men don't push like they used to anymore?
Hold on now. Hold on.
Hold on. Yes, let me rephrase that. Let me rephrase that. Before,
Big Clint,
a
buddy.
lot of the male population themselves don't see themselves in these positions.
Yeah,
They don't want to work 9 to 5
Hold
for
on.
a salary.
Help
They
me.
want.
No, let me let you understand it. Let me let you understand it. There's a couple factors in there. First, I see go. Some males might not understand or see that.
See what?
Prime example. Let's say that's how a prime example of the bank. In the bank, you automatically, if you're not in private banking, before you even get to private banking, you will need some experience in commercial banking. But when you start in commercial banking, everybody starts as a teller. Yes, a teller may not be the most what it is sought after job or whatever, but at the end of the day, it's your foundation, like Mr. Wilkinson said. Once you have that foundation, you can go anywhere in the bank. But that particular starting position doesn't pay what the average male think he needs to pay to say, oh, I can't take my girlfriend for concert on Sunday, or I can't buy this, or I can't have this type of car. He's not gonna say, hey, if I know if I stick it out maybe for like say 6 months, I could get a promotion and I'll get way more benefits and maybe and way more salary and going into long term. But at that in that particular time, he thinking like for right now, he ain't seeing what could happen down the road, whereas he can get a massive increase because it's very few males that even get past the data teller. And that's the problem, whereas I see like they see what money in front of them now instead of what could be down the road.
Folks, let me tell you a secret.
That's what I mean by
Let
psyche,
me
man.
tell you something about the Bahamas. We suffer from something called incest and child molestation, don't we?
What?
Yes, I agree.
That's
I
going
know
after.
where I'm tying this in. You'll see in a minute. We do. Okay?
Mhm.
That's a major problem we have. We also suffer from the absence of fathers in the home.
Yes.
Now, the question is, how and when in the hell did that happen and why?
That's why I was asking, do you think that it has something to do with men themselves not pushing the way they used to?
Well, maybe. And the question is, what made them stop? That's my point. What made them stop in such huge numbers? It's
I
a
don't know, you
very-
tell us. What is it?
it's
I
a-
wouldn't know. I wouldn't know.
It's a
I think it's
very,
complacency.
listen, let me tell you.
It can't be complacency because I think it's just lack of funds. That's what I think.
No, it's not that. Remember, we had a generation back in the 80s that got caught up with all kinds of drug money,
Drugs, right?
this quick money,
I'm
this
going to
other
tell you
stupid
that.
American culture, and all this crazy stuff.
Mm-hmm.
There are a lot of things like that that impacted this country for men.
Mm-hmm.
And then on top of that, the older educated fathers and men gave up their responsibility of fathering their sons, period.
And that is when women
And
stepped
that,
up.
and then the women were forced to step in. The
Okay.
only problem is they can't be a man nor a father.
No,
And so all of a sudden, the male children get left behind. One, because mom cannot do it,
right?
and two, because dad isn't doing it.
Doing it. Exactly.
Simple. Simple as that, but complicated. Because now that we have a generation or two of men who have suffered from the mom who couldn't and the father who didn't, it's not that easy to fix it anymore. And so here we are. And I keep telling people, if you have an idle female, she might just cry, knit, or go over the thing and talk, watch something, and just kick back. But an idle male or a male who feels disillusioned is hell on any society's hand, as we already seen. And if we don't do something to get men back in their position where they can feel worthy, they are going to extend their anger to a greater section of society. That's usually the result.
I don't think they put emphasis on the males in terms of letting them know that the amount of opportunities out there. Though,
Let
'cause,
me
like,
tell you a secret, young man. You could see, let me tell you, we still don't understand how important it is for a male child to have his father in his life directing him. That's the other problem.
Mm-hmm.
We still think that some government, school, money, or opportunity will do it. It will not.
Mm-hmm.
And I keep telling people that we cannot substitute material things for what God has instructed. And He's instructed that you are the father, or else all hell will always break loose. Always. I don't care what opportunities you have. I don't care how much money you have. I don't care what you do. If you're failing in being fathered or being a father, eventually it will all be a mess of some kind or another.
Simple as that.
Make no mistake about it. You could try and get some material and opportunity and see if it'll work, but it won't. I
Mm.
guarantee you. Guarantee you.
That's what a lot of these young guys suffering from today.
They are. They are fatherless and unloved, angry, and don't understand why they are the way they are.
Mm-hmm.
Because now they've already grown up and there's nothing they can do about it. And so they lash out and hang around and waste
Mhm.
time because nobody ever taught them how to be diligent,
Right.
hardworking, and to pursue. Nobody. Mom is busy and dad doesn't give a damn because he's too busy running behind women, wasting time, being angry with mom, and all kind of BS.
Just rude.
Doggone it.
Oh,
And I'm saying that for you young men in this class. Don't do that foolishness. You are on the right course. Stay there. When you have your children, male or female, but especially your male children, don't do that to them.
Mhm.
Stay your hip next to them until they become men and then going in the direction they need to go. Don't do that foolishness that our forefathers did. But their mommy, their mom make me mad, they're your children, and leave them alone. Where's my daddy? Doesn't he love me? He wouldn't even sit down and read. Let me read to him. He never told me he loved me, never hugged me, never nothing. And then we want them to grow up to be what? Model
Loving
citizens?
fathers.
Doesn't work that way because God does not make mistakes. He said, you want what you want, then you have to sow. Whatever you want to reap, you had better sow it, or else all hell will always break loose. I don't care how much material stuff you have. Doggone it, how did we get to that? Sorry.
because in
I
1973.
guess you guys, oh yeah, 97. Kiss my foot. I guess you guys have figured out that's a sore point for me.
Yeah, I was gonna say, obviously, I mean,
Yeah. You're very
I
passionate
am
about it.
fed up with fathers who have left their children in general alone and their sons in particular.
Mhm.
All of them, from politicians, pastors, right down to the doggone guy in the Rasta camp, whoever it is, they have left their children, and more specifically in the last 20 years, 25 years, their sons alone to flounder around and make his own way in a mean and nasty world, by the way.
Mhm.
But they're busy, their job, their ma get me mad. I have other women to run after and pay. What kind of foolishness is that? How do you put your children behind all of that? My. I don't care what your reason is. They are the priority, period. Until they become men and women, and they can go in the direction that they need to go. Until then, it is our responsibility as their parents, and more importantly, as their father. See, we take this father thing too lightly.
Serious
That's
thought.
too lightly. Too lightly. We just think that we're a bunch of sperm donors who throw out rent money and this thing every blue moon. Man, that's not what being a father is. Dogs and cats and every other animal are sperm. Correct?
This is true.
Okay. All right. I think somebody needs to stop me because that is a sore point. I am fed up with irresponsible fathers, and we are now suffering, and more as a society, and more importantly, those young men who never got the opportunity to have a father to love them, guide them, discipline them, and direct them. How terrible to bring a child in this mess and just flick in, walk off, and leave them to wander around. What the hell is that? I don't care who the father is. And you don't need to be poor or rich to do what I said. The poorest person in the world can do everything I said. And so can the richest. And that's the beauty of God's way. But we keep ignoring it, doing our own thing. Now everybody's suffering, not the least of those young men who are now confused and unloved with no direction and no way of finding out how to get anywhere because nobody ever guided them, showed them, held their hands, loved them, nor fucking disciplined them. My. Okay, who said 1973? Mario. I don't know why you said that. All right, so everybody sees how we got the 1973. So once we calculate the simple interest, we just simply add it onto the principal and we have what we call the maturity value. Okay, so when you put your fixed deposit in the bank or your money in your savings account and the interest rate is 8% for 90 days, you should expect to see $19.73 in your account. That's really what this is all about, in case you're wondering. Okay, it's not just for you to pass an examination. All right. Anybody ever heard the expression accrued interest?
Right in this class.
Yeah, right in this class. What do you remember that was?
When we was going through accrual accounting, and it's like something that's built up over time.
Yes.
Expenses.
Yes, an accrued expenses, yes. An accrual is an amount that is due but not yet paid. It builds up. So if you work overtime and you'll be paid next month, whatever overtime you work this month will be accrued for this month and paid when? Next month. Okay, that's how accrual works. Okay, whether it's salary, interest, or otherwise. We calculate it for the accrual period, and then when the time comes to pay. For example, if you open a CD for 1 year, interest will accrue on that for 1 year. And at the end of the year, then the entire amount accrued will be added to your principal. Okay? Simple as that. And then a dishonored note, on the other hand, what is a dishonored note? How is that defined?
That's something where people don't pay.
Yeah, yeah, I like that. When the maker of the note, you make the note and promise to pay and then don't pay. It is said to be a dishonored note because you did not honor it. Pretty much explains itself. It's like a promissory note, but you don't pay. It's like an accounts receivable. Okay, you sell something on credit, they promise to come back and pay, they don't come back. That's kind of a form of a dishonored note. Except in the case of an accounts receivable, it's a trade account. A dishonored note is a promissory type note that you agree to honor or pay at a certain time, and you don't, which means that for you, it's a liability. You do not pay it off, and therefore you've dishonored the note, and that's by extension, dishonored the arrangement. Which people tend to do all the time when they get ready. Okay, do all kinds of weird stuff. All right. Any questions before we move on to our final chapter? Pretty much. Sorry? That's pretty much all we need to do for that chapter. If you get any questions on notes receivable, it cannot be more than what we discussed. And that last part was pretty straightforward, except don't subtract 21 from 31. You're going to get the wrong maturity. Okay? Remember, you cannot use the note date. And when all else fails, use your fingers to count for the first month. And you'll be fine. All right. Couple of things in my chapter 10, I believe is your chapter. My chapter 10 is your chapter what?
No, it was our chapter 10, your chapter 11.
My chapter 11.
Long-term assets.
Yes. Anybody knows what that is?
Buildings. I mean, that's an
Okay.
example.
Building is an example, yeah.
Pretty much like hard assets, which not able to liquidate quick.
Yeah, assets that do not liquidate quickly, usually within 1 year. We refer to them as
So
long-term assets.
long-term assets.
Okay. Short-term asset or current assets are those that tend to turn over, liquidate within 1 year. Remember, the accounting period is usually 1 year. So if it doesn't liquidate or turn over within 1 year, we refer to them not as current assets, but rather long-term assets. Okay? And what is the reason for company having assets? Assets is simply there to help the company to generate revenues, because out of revenues come profits. And the primary reason why we go into business to begin with is to generate, anybody knows?
Profitability.
Yeah, profitability. And whenever there's no profitability in a particular entity, especially if it's for profit, they're going to start getting rid of people. And if that doesn't work, start getting rid of other things. That doesn't work, eventually close their doors. Okay. So yeah, and long-term asset has a role to play in the revenue generation for the firm, and certainly its long-term profitability. Okay, for sure. All right. So right at the top, they give us a nice little definition of long-term assets. They tell us it includes things like land and buildings and equipment and natural resources, etc. What is a tangible asset, anyone?
Something you can touch.
Yeah, something you can touch. And as such, what would be the opposite?
Something you can't touch. Intangible.
Intangible, yes. Okay, way to go.
What is the patent?
Oh,
Like,
somebody
does
give it a shot. Yeah, patent or patent, whichever one you choose. What is it?
Something you can't touch.
You can, but I mean, it's intangible. But what is it? What do we give patents for?
Intellectual property, right?
Yeah, it's kind of like intellectual property. So if you create something, you may take a patent on it. It's like a copyright situation, so that you can have exclusive rights to it forever or for a defined period of time. Okay, so if you create something, somebody will say, did you get it patented? Meaning, did you go to the government and set it up legally so that nobody else can steal your creation?
Do they do that over there?
Do what? Patent stuff?
Yeah.
Yes, you can do it here. It's not a big deal here like in other countries like the US and Canada, UK, and Europe and all those places, China. Nobody knows what the hell goes on in China. Nobody owns anything in China. Anyway, in China, the government owns everything. Did you know that?
So what about those people who is be expanding and go overseas to China?
What people?
Like, let's say it's a big manufacturing company for some merchandise where they do mass production, and instead of expanding in different states in America, they decide to expand and buy like some property in a warehouse and hire some people in China because it may be cheaper.
Well, I
The
suspect
question is like, does the government own all of that in China, or like does the government pay?
theoretically, yes. We don't really know for sure exactly the extent to which it is, but the concept of private property in China is not typical. Like how you could go anywhere in Nassau and buy property if you have money. The typical Chinese cannot necessarily do that. Does that extend to everybody? We don't really know. But typically, no.
The average manufacturer don't really go to China. They purchase from China, but they don't go to China to build. They go to like Panama and all them other countries.
True.
And
True. And even if they open up in China, it'll be on China's what? Crown land. I don't think they allow you to buy the land. I don't know to what extent they do it, but typically the communist government controls pretty much everything in the country. So this thing about private property that we have in the Western world, it is not typical in places like China. Nor is it typical in Cuba, which is a communist country.
They say Cubans don't let people leave.
No, you have to sneak out as usual still. Okay? As you notice the vehicles in Cuba are from the 50s.
Yeah.
They
So they don't
refuse-
import stuff, you know?
No, well, they refuse to upgrade certain things in Cuba. And to some extent, I understand that they refuse to negotiate business in US dollars. They refuse to accept them. Because they're
Yeah.
pissed off Uncle Sam.
You have to carry Canadian or Euro.
Yes. Okay. And this is one of the reasons why Uncle Sam is present in the Bahamas, no doubt, because Cuba is very close to Florida. You know that, right?
Mm-hmm.
And Cuba is a communist country that you can hide weapons and atomic weapons and other stuff. You know that,
Yeah.
which means that the
Oh.
Bahamas is typically in jeopardy as long as Cuba is a communist country.
Mm-hmm.
Because if anything break out, they're going to be fighting over our heads. Did you know
And
that?
as long as they have as long as they have enemies like Russia and China, they're gonna watch Cuba and all those
As long as
countries.
we have communist countries, of course, Cuba is a satellite country in this part of the world for China and Russia.
Mm-hmm. Yep.
We don't talk about it that way for some strange reason. We got our head in the sand as usual. Okay? I saw, with all due respect, they brought over a bunch of Cuban nurses the other day. Why them?
How the Cuban nurses get it if Cuba don't let people leave?
No, they'll let them. When leave doesn't mean you leave for good. Leave means you
Good.
come, earn
Yeah.
US currency or whatever, and come back and bring it back,
Mm-hmm.
along with any other information you could bring back with you
Mm-hmm.
on the Bahamians and the Americans and anything else potentially. Are the nurses doing that? We don't know, because we don't know anything about what communist countries are doing other than what they say. And nobody can believe anything they say anyway. We could hardly
So,
believe
like,
what democracy is saying.
let's say, I I don't want to do that to like cause a long conversation, but does the Cuban government treat visitors the same?
In what way?
Like, not I wouldn't say like holding them against their will to leave, but like
No. No.
No, visitors, they welcome visitors because that's how they earn hard currency. They just don't accept US currency.
Right.
So if a Bahamian wants to go to Cuba, we cannot go with US dollars anymore.
Right.
You have to go with Canadian or Euro. But if you go there, they'll wine and dine you and treat you like they treat any other tourist.
Mm-hmm.
But that doesn't mean that they're all hunky-dory with their own people. Because the people are stuck and they don't have any rights and they can't own property and they don't own anything because the government owns everything, including them.
The government feeds them, the government clothes them, the government do
Everything.
everything. They don't work.
So when you go to study medicine, you don't earn an income, you earn a small fee to keep you alive.
Mm-hmm.
When you become a teacher, you earn enough just to keep you alive, you and your family. You don't own anything significant in a communist environment.
Yeah.
Only the leaders on top own stuff.
So like they're not expected to pay rent and things like that.
No.
Wow.
The only problem is when people are paying for you, they own you.
So like there's no difference with there's no like classism then.
No.
Mm-mm.
Okay? The richest
sounds
people in the
scary.
world are the leaders like Putin, that fat boy in North Korea, and so on, with all the gold, the silver, the cars, the houses. They have everything. But the rest of the country are starved with nothing.
Mm-hmm.
That's how communism works. The gods of the country keep them in fear and poverty while they keep and thief everything else.
Mm-hmm. Just enough for that day.
Doggone it.
Wow.
Okay. So those of you who live in a democracy like the Bahamas, thank God and try to keep it that way. Because if you find yourself under a communist regime or a dictatorship or a Hitler type regime, dog eat your lunch.
And drinking milk.
Man, We can say all kind of mean things about our prime minister and get away. You go to China and say something about Xing, they'll never
Mhm.
find you again.
Exactly. They don't even know when you disappear.
They'll never find you again. In the Bahamas, we so free, we can say, oh, stinking minister, stinking prime minister, stinking dog. We say all kind of stuff and get away with it. Because we're in a democracy. Take it for granted.
Oh
Because we
Lord.
don't really realize how free we really are compared to countries that are not free like us. Same thing with the Americans. They so free, they don't even know what to do with themselves anymore. They don't even want to call themselves men and women, boys and girls anymore. They call themselves it, other, fluid, dog, chicken, rooster, all kind of stupidness. They don't know what to do.
So like when y'all see certain Bahamians being like, oh, the government need to do this or the government need to do that, boom, 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 boom. Is that them pushing for a subtle communist government, or that's them wanting the government to do more than they really
No,
do?
they just want the government to do more. Okay? Most of us are not interested in communism,
No.
dictatism, or doggone fascism, which was Hitler and his garbage.
Mhm.
Okay? Most of us in this part of the world just want to be able to go to vote, make noise, carry the junk canoe, put your X, and make noise about who should do more and fix things like that. They
Yeah.
continue to enjoy the freedoms.
And do road.
Yeah. Because half of the world don't know anything about democracy. The eastern half of the world, they know nothing about democracy like we do in the Western world. Take the whole thing for granted.
Mhm.
Okay, all I can tell you is if you have a democracy, make sure it's a long-term asset. That's the chapter we're in, by the way. Because I tell you, those other regimes, they are a nightmare.
Yeah.
It's just that we don't realize it because we've never had to live under it.
Mhm.
See those Cuban chicks who come over here? They're gonna be having a ball depending on who they are. If they haven't been totally indoctrinated, some of them are not going back
And that's the best they ever live in their life.
ever.
Ever.
See?
The
And in
food and thing
America,
that
if
they
you walk
see,
past one of them, you're gone.
only
Mhm.
Bahamians can't live good, yeah.
No man, you can teach me. You can teach me. I know that my family have experiences with
Bahamians
those.
have no idea how fortunate we are. We still continue to take everything for granted because even the poorest Bahamian having a ball compared to the
Yeah.
half of the world that's poor.
Mhm.
Our poorest Bahamian is richer than half of the world. Did you know that?
I know that you really see you see them, but you
Our
really
poorest
see.
Bahamian is richer than half of the world. Okay, folks? In China, if somebody makes $50 a month, they are gazillionaires, US. In India, half of India,
Mhm.
if they make $20 a
Jesus.
month, they feel like gazillionaires.
Mhm.
And
Yeah,
half
that's
of
a fun.
Africa, same
Can't
thing.
buy a bit of food when all this properly.
We have no idea. We are poor Bahamians who gambling, like passing gambling. We are gambling, poor Bahamians. That's how rich we are compared to half of the world.
Yeah.
But we don't get it because we keep taking things for granted. And the primary reason for that is because Bahamians have never really suffered.
Had to suffer.
Yeah.
Yeah.
No, we have not.
Mhm.
Not really.
We have it good.
The pandemic, we thought that was suffering. That's a joke. Bahamians have not really suffered yet, like other countries. Okay?
What you saying is Bahamian spoiled.
Yes, we spoil.
We are
We
bunch of
spoiled.
spoiled bastards.
Spoiled and disrespectful.
Yes.
You know how much
Which is
other
We
Caribbean
low key spoiled
countries
though. We low key
gotta,
spoiled. We low
how
key.
much other Caribbean countries gotta come here to get a US visa?
Of course,
Yeah, with US pre-check. That's like one of the
we're the
and
only
I'm like,
country with it in
wow.
the
Yeah.
Caribbean.
Yeah.
We are the only country with pre-clearance in the entire Caribbean.
You can imagine a man been trying to go through customs on the next side. You I say like, what type of system situation this is.
Well, that's, maybe we
Not
need
them
that.
out all
It's
day.
just a lesson. That's what we need. We need real hardship.
No, not right now.
No, not right now. Not right now. Not right now. I can't deal with that. No.
Mm-mm.
Well, let me tell you a
different ballgame.
secret. You see all those thousands of Ukrainians, they don't need that right now either, do they?
No.
I'm
No.
very happy. I'm very happy U.S. Embassy built that nice state-of-the-art fortress.
That means they come in to stay.
They come in the state. They come in the state.
Well, all I can tell you, youngsters, we need them to stay.
Yeah.
Otherwise, dog eat our lunch. And we better be careful who we go in bed with politically.
Chinese. I'm Chinese.
You mean again?
Well, I'm going to glory to have milk and honey and all that. You guys are gonna be here with that
Yeah.
nonsense. Just be careful. Be smart.
Yeah.
Be sensible. Okay? All right. Okay. Oh, God. From 1970. Oh, long-term assets. So these long-term assets are also called fixed assets in accounting. And they have certain characteristics that you need to know. First of all, they have useful lives, as we said, that is more than 1 year. That's the first characteristic. They are used in the day-to-day operation of the business to generate what? Revenues. Okay. They are not intended for resale. See, inventory is intended for resale, not the assets. The assets are there to make stuff and to help generate revenues in one form or another. We don't buy them to resell them. Now, if we are a tractor company, manufacturing company, then we're selling tractors. But if we use a tractor in order to move trees because we have a tree moving business, then the tractor is no longer inventory. A tractor is a long-term asset to help us make money, generate revenues. Everybody see the difference? Hopefully. Long-term assets are also referred to as plant assets, P-L-A-N-T. And the reason why we call them plant, because they're fixed, they don't move like a tree. They're planted. They are usually tangible. You can touch them and they depreciate. These are all characteristics of long-term assets. Natural resources are also long-term assets. What is an example of a natural resource, anyone?
The tree.
Sorry?
I was saying the tree.
A tree?
Well, stuff like coal.
Yeah, coal. One more example of a natural resource.
Oil.
Oil. Natural resources are not depreciated. They are depleted. However, it's just semantics. We use depreciation for equipment and machinery, etc. We use depletion for natural resources. That in both cases, they lose value, as you'll see later. Okay. We already said that intangible assets are assets you cannot touch, like copyrights and patents. And we reduce their value not by depreciation or depletion, but by another word called amortization. However, depreciation, depletion, and amortization all have the same function. They are designed to reduce the original cost of the asset. And once you understand that, it makes it so much easier to put it in perspective. All right, how do we define carrying value, anyone? How do we define it? Carrying value or book value?
I take it that's the amount we'll just go on the adjusted trial balance.
Okay, yeah. you put it in a way that somebody would really have to know their stuff to understand what you mean, Mario, but yes, you're right.
Objective.
Absolutely right. I like that because you really have to know your stuff to know what you mean by that. All right. Put another way, carrying value is what we refer to as the undepreciated part of the asset. For example, if the asset is worth $10,000 and depreciation is $2,000, The remaining 8,000 is referred to as the carrying value. Okay, folks, simple as that. Don't complicate it. It's the undepreciated portion of the asset. And if you remember it that way, then you should be fine. All right. So let's talk a little bit about acquiring long-term assets. I'm not going to put you guys through the calculation of present values at this time. That's more for accounting too. When you get to that, what I really just want you to understand is basically how firms go about purchasing or acquiring long-term assets. Okay? That's my goal for the rest of this evening. So let's follow me down the line. By the way, what does financing mean?
Funding the people.
Okay, funding. What else does financing mean? What does it mean to lenders?
Borrow and pay it over a period of time.
Yeah, borrowing and repaying, indeed. When you finance something, you are, we say in Bahamianese, you're borrowing. But yes, financing means borrowing. Okay, you finance a car, you're borrowing money for the car. You finance a house, mortgage, you're borrowing money for the mortgage. That's what financing is all about. In fact, a lot of banks are now anxious to give mortgage financing now that the pandemic is over. They need to give more loans so they can make some more money. And so they're offering all kinds of incentive to persons who want to get a mortgage. If you already have a mortgage, they have all kinds of incentives now for you to switch your mortgage from your current bank to their bank. Okay?
Does that mean that the interest rates are lower?
They are obviously going to lower it, try to bring it below the competitor bank. And so the competitor banks where your mortgage currently is are watching them as well to see who's trying to steal their clients.
It's a competition.
Yeah, of competition, exactly right, which is a good thing. Okay? That means at the end of the day, many people are going to end up getting better deals on their mortgages. Because some lenders where customers currently are may not be prepared to reduce the rate. And so you go over to the other lender who says, I'll reduce it by 1%. It's a whole entire 1%. I'm out of here, moving over there. Other
That's a lot.
1% is a whole lot for a mortgage. May not be a lot for a $5,000 loan. But if you have a $200,000 mortgage and you have a 1% interest rate difference, over 25 years, that works out to tens of thousands of dollars in savings. How about that? Yeah. A change of 1% can result in tens of thousands of dollars in savings, particularly on mortgages or loans with very high principals amounts. Okay. All right. You need to know the difference between capital and revenue expenditure. Capital expenditure has to do with purchasing assets and upgrading assets, while revenue expenditure has to do with maintaining long-term assets. Not complicated. Okay. In accounting, sometimes you'll hear certain other expressions like additions. And we're told that additions are what? Just enlarging the physical layout of a plant. So if you have a warehouse that's 5,000 square feet and you expand it to 10,000 square feet, that in accounting, that's an addition. Okay? On the other hand, we have betterments. What is a betterment, anyone?
Renovation.
Yeah, like renovations. They improve the plant or asset, but they don't add what?
Value.
Value to the physical layout. Okay. So yeah, you painted, you fixed the roof that's leaking and this kind of stuff, but it doesn't really add anything more significant than that. You install.
Oh, sorry, you can finish.
Go ahead.
So I mean, like, let's say, uh, people have some like old houses, right? Already
Mhm.
paid off and everything. If they go renovate it, okay, boom. Let's say the house is old, a couple decades old, but it's already paid off. The
Mhm.
value is like, let's say, I know it's probably not realistic. Let's say like it's $100,000, right? After they
Right.
renovate it, they can sell that for like at least
They
110,000.
could. No, they could. Renovations doesn't mean that it will not improve the market value. But let's say, for example, if you just renovate it, you could improve the market value, but that would not be considered an addition. That'll just be considered maintenance. Now, if you add another room or two to it, that's an addition. Okay? What you're talking about might be considered a betterment. Putting in an AC, painting it, and doing general renovations might be considered a betterment. All right? In terms of practical accounting. And then of course we have something we call extraordinary repairs. Now, what are these extraordinary repairs? We are told that they what? Significantly enhance a planned asset's estimated useful life. In other words, it's like rebuilding an engine. So before you rebuild it, the life of the engine might only be 2 years. Once you rebuild it, you can extend the life of the engine to maybe 5 years or 7 years. Okay? That's what we mean by extraordinary repairs. Okay? If you have a piece of equipment that you use to manufacture whatever you make, and you do significant refurbishment of that equipment, you may extend its useful life well beyond its current remaining life, whatever that might be. Okay? Whenever we do that to a long-term asset, we say it's an extraordinary repair. Okay? So we have additions, we have betterments, and we have extraordinary repairs. Do accountants still argue over what falls into where? Of course they do. But generally, those three examples that we gave are typical in each of those particular situations. So it's just a matter of, now, when you guys are looking at those things, of course, students are required to read stuff. That's a given, much as we hate it. But when it's time to remember what it means, typically it's enough to remember what it is and an example of it. See, what it is, an example of it. That's why it's so important to always be reading ahead. So when it's time to review and study, you don't have to reread everything again. You just focus on the key core issues. Okay? That's the trick. Always stay ahead of your reading so you get all of your reading in, not only for examination purposes, but for your own edification going forward. And then when it's time to review, you don't have to reread chunks of stuff anymore. You just focus on key issues, key calculations, key definitions, key issues, because you've already done your reading. Okay? All right. So let's look at specific types of assets, long-term assets. First of all, land. But the first thing you need to know about land is that land does not depreciate. Okay, folks? So if I ask you to calculate depreciation on land, just put on a note on that. Excuse me, Mr. Wilkinson, land does not depreciate. Okay? Does that mean the value of land cannot go down? Sure, it can go down, but normally it doesn't. So for accounting purposes, land typically does not depreciate. Land typically what?
Appreciates.
Appreciates. Okay?
What's the logic behind that?
Behind what?
Land not depreciating.
Because over time, historically, land tend to go up in value. That's the logic, if you could call it logic, but more the rationale than the logic.
Is it
Okay?
a fundamental because there's no more land being made, or just saying it?
No, not necessarily, even though your point is taken. That could be one of the factors depending on where you are. But typically, for example, land in New Providence is far more expensive than land in the Family Islands.
Is that so? There's more people
That's
there.
primarily because the New Providence is much more developed. A greater
Okay.
population, more economic activity, more opportunity. So land values tend to go up more. Okay, so again, a lot of different variables determine the value of land. Typically, as a result, it goes up in value year over year. Does that mean that something can happen that land can decrease in value? Of course. You can have a couple of mechanics move in, some, a couple of Rasta camps and a bunch of guys shooting up guns at night. That'll do something to land values because people then start doing what?
Moving out.
Yeah, and even if you don't move out, the value of your property is still going to what? Go down. Because who's going to buy land in that area? And if somebody who is not have quite a bit of money wants to buy land in that area where that crap is going on, they're gonna want to buy it at a reduced rate. So you're gonna have to sell at a lower price anyway. So down goes the value of the land again. For that reason and other reasons. Okay. So land values are very fickle. They're like the mood of a female. One minute it could be this, the other minute it could be that. It's like a hurricane, but not quite that fickle.
Yes, sir. You're right, Mr. Wilkinson.
Yeah, she agrees with that. Absolutely. Yeah, strange. All right. But then again, um, I keep telling people God doesn't make mistakes. You notice, even in moods, a man's mood is different from a woman's mood. It's not about whose mood is better than whose. See, the problem is I found now that, everybody's competing for materiality and status and all that stuff. Men and women are becoming more and more enemies rather than working together towards a common goal. They're like fighting with each other all the time. Like my grandma used to say, like cats and dogs for some strange reason. And that it was never designed to be that way. Because again, like who's smarter than who's dumber than who's stupider than all these different things that we're going on with because we're creating this crazy adversarial relationship. And if anybody believes in the devil, we know that he's the master of adversarial relationships. That's how he thrives. That's why he constantly keeps men and women fighting each other for all kinds of stupid reasons. Interestingly enough, because really the design was not for us to fight with each other, but rather work with each other. That's why God gave us different body size, strength, even moods. Men are not as moody as women, but women are moody for a reason if you're doing it for the right reasons. See? Men are moody too, but in a different way, for different reasons. And we keep moving away from the core issues. And soon people are moving so far away, they don't even know how to get back anymore. Like, where did we come from? We don't remember anymore. We're flicking lost. And so what do? Just keep fighting each other, which is kind of where we're headed and where we are, whether we believe it or not, unfortunately. And who's in the middle of the war? Sure in them. See? Innocent little children watching this crazy stuff like, what the hell? Not knowing which part of this whole thing they're going to become eventually and having no control over anything except to take responsibility for whatever they turn out to be as a result of the madness. It's crazy as hell. All right, so let us assume then that a company buys land for a new retail operation. The net purchase price is $340,000. The company also pays the brokerage fees of $12,000, legal fees of $4,000, $20,000 to have an old building on the site torn down, and $2,000 to have the site graded or cleared. It receives $8,000 in salvage from the old building. The cost of the land is therefore no longer $340,000, which is the net purchase price, but rather $370,000. And the question here is, why do we calculate land the way we do? And how did we end up from 340,000 to 370,000 for the cost of this land? Well, you can see the steps are clear. We start off with the purchase price, we add what to it?
Fees,
Brokerage fees, and we add what else?
legal fees,
Legal fees. And then we add what else?
anyway, tearing down the old building,
The net amount.
the net amount,
Yeah, the net amount of tearing down the old building is how much?
12,000. What do they mean by
12,000.
salvage? Like moving the material what was knocked down?
Yeah, what's left? Salvage is what's left. So they tear
Oh.
down the whole building and then they sell some stuff. God forbid what that could be. Who
Wow.
knows? Maybe some beams, some other pieces of the house is valuable to somebody. In this case, they were able to sell enough for a total of $8,000. So it cost them $20,000 to tear it down. They made $8,000 from selling bits and pieces. And so the net cost of tearing down is not 20, but rather $12,000. Okay. And of course, the final cost that they had to incur was grading. And what do? We add up all the costs. And so the total cost of the land is $370,000. Just like when you go to Miami to buy a car, but you pay $20,000 for the car over there. By the time it's landed and you pay customs duties and all the other things, it's not going to be 20,000, correct? Will you bring it here and charge and sell it for 20,000 if you pay 20,000 in Florida?
No,
No.
that'd be just breaking even.
What
Actually,
would
that'd be a
break even?
loss.
Losing money.
Yeah, that'd be a
So
loss.
in order for you to make a profit, what you have to do with that car before you sell it?
Mark, whoa. Ooh, total the cost.
Yeah, whatever you paid from the invoice price to getting it landed in the Bahamas. You have to add all your costs in, including plane ticket and hotel, if you want to recover everything. So if you buy a car for 20 and customs duty is 50%, then that's 10,000. So now the car is not 20,000 anymore, it's 30,000. Shipping is 3,000. So you have to add that on, it's 33,000. VAT is whatever the hell VAT is. That's another 2,000. 35,000. So suddenly your car you paid 20,000 for in Florida is no longer valued at 20,000. It's 35,000 now. And after the 35,000, you still can't sell it for 35,000. You could, but you're gonna what? Lose money. If you want to make a profit on that, you have to sell it for an amount greater than 35,000, like 40,000 plus, to make a profit. And so that's how we determine the value of long-term assets. So does anybody know what leasehold improvement is?
I would like to. I could read it.
Sorry?
I would like to, but then I just realized I could read it. So you can explain what it is.
Or you can say, what is leasehold? When you lease a building, what are you doing?
You holding it for a couple months.
Temporarily, renting or
Yeah,
Right.
renting.
temporary
Yeah.
owning it or renting it.
Renting it. Leasing is renting for a period of time, okay?
Yeah.
So basically, let me just back up a minute. We're looking at the components of long-term assets. We started with land, then we have land improvements. That's another component of long-term assets, which increases the value of the land. Of course, building is another long-term asset. So whatever cost goes into the building of the building or the purchasing of the building, that total cost is what will show up on the balance sheet. Remember, just in the land value, you have to add all your costs when you acquire long-term assets, okay? All your costs. whatever they might be. Okay? Leasehold improvements are long-term. Usually those leasehold improvements run for more than 1 year. Okay. Typically, whenever we create leasehold improvements, what we're doing is we are maintaining the landlord's property. Okay. The lease itself is the rent. Leasehold improvements is the work that we do to the property to keep it up and running, whether it's an apartment or a business, a warehouse for doing business. Okay. You should if you're leasing from somewhere or renting, you want to keep it in reasonably good order, but you don't want to spend an inordinate amount of money maintaining somebody else's property, only sufficiently that you can live there. And oftentimes you should try and arrange for them to maintain it, not you. If you sign a lease saying you'll maintain it, you might end up doing more for their property than you need to. Okay. That's something to think about. Equipment is another long-term asset. We know what that is. All the expenditure connected to getting it and installing it would fall under same as with land. Okay. Now, sometimes we don't purchase long-term assets individually, we purchase them in groups. So group purchases in accounting has a very special process. And it's not complicated. It's just something we learn. For example, here's a simple formula for coming up with group purchase assignments. I'll show you in a minute. Let's say we are told that there's a transaction for, what is the amount of the transaction under group purchases? Company buys a building and the land on which it is suited for a lump sum of how much?
180,000.
Is it 180,000?
Oh, 170,000.
Yeah, 170,000. Okay. Now that's what the company buys the land for, a lump sum of 170,000. The company can apportion the cost by determining what it would have paid for the building and for the land had it purchased them what? Separately. Okay. So in this case, they initially purchased them together for 170,000, but they don't want to put it on their balance sheet as 170,000 because in accounting you have to put them on separately. An amount for land and amount for building, and show them separately on the balance sheet. That's all this group purchase thing is. So how does the accountant do that? Well, let's move on down to the steps that we take in order to apportion group purchases, like how much will go to land and how much will go to buildings on the balance sheet. First of all, the first thing we are told to do is to have the land and the building appraised. So everybody see that?
Yes.
What's the appraised value of the land?
20,000.
Building?
180,000.
Okay. So together, appraised would be a total of what?
200,000.
200,000. Now, the allocation percentage is 10% for land and 90% for building. Where did that come from?
What do you mean? You mean that portion, or
Well, where did those rates come from? 10% and 90%.
I mean, I see it in the paragraph in the
Okay.
case.
What did they say about it? In that
And
case,
the value of the land is only 10%?
the amount of, not the value of the land, the value of the land is $20,000.
Right.
But remember, we are looking to apportion the land. Remember, we paid 170,000 for the land and building, and we're trying to find out how much of that 170,000 should go on the balance sheet for land, and how much of that should go on the balance sheet for building. We can see from the appraisal right away that the greater majority will go to which one?
The building.
Of course, because it has a higher value. Okay. But before we can get to finding out how much that will be, we say that we apportion 10% to the land and 90% to the building. Anybody knows why we apportion 10%?
Because the land is usually the cheaper of the two.
Well, in this case, it's cheaper. Doesn't have to be.
No, well then, no, I don't, unless other than them telling us to.
Interesting. Well, let's say management makes a decision to apportion 10% to land and 90% to buildings. Okay, let's just say, just like uncollectibles. Remember that? Let's say they do the same thing here. So if we do that, then notice, well, before I go there, let me just see if you notice something in brackets under the percentages. Let me see if you pick it up.
Okay, I see it. That's what they did was the total appraisal value. They divided the 20,000 by the total value and 180,000 by the total value.
Excellent. She picked it up. Excellent. Okay. And so we have our percentages. And then what do we do?
Right.
Calculate them.
How do we apportion it? We take the what? 170,000 we paid for both of them and apply 10% to land and 90% to
The building.
in the building.
So
on
the
our
appraisal is an important aspect.
that's the first step in order to apportion it correctly. So that we have the right amount and the right values going on to the balance sheet. Okay. So how much will go onto the balance sheet for land of the 170
17,000,
and the building?
153,000.
Simple. And we only use this method if we purchase assets as a group. Okay. If it was 3 assets or 4, same principle applies. As far as
Would you do it separately or together?
when you say do it separately, you mean
The amount. Like
Which
let's say each group let's say they do 4 group purchases, like you say, and they buy them differently. One is 153, the other is 176, blah 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 blah. Do they get them separately appraised, but like do total value?
oh
Or
no,
they
if you buy them individually, there's no need to do any appraisal. You record them at cost. You follow? Like if you
I
buy
think I
land
do.
only for 300,000, then you debit land for 300,000.
True.
If you buy a building only, then you debit buildings for 500,000. Because you're
Which is
buying them
why
separately.
that's why this percent thing and this appraisal thing only apply to when you buy it as a group.
Absolutely.
Okay.
Just like ignoring the note date only applies when you're dealing with what? Maturity dates, see? Yeah. The rules. Absolutely. The rule says when you're passing somebody in the morning for the first time, you say good morning, see, rules.
I think that's a rule. I think that's how he was raised.
Yeah, rules. I know. We have all kind of different synonyms, but it's the same thing principle. In the old days when I was growing up, if you pass an elderly person of any kind without saying good morning, they reported you to your grandparents or your parents, and you can be assured that that will be a cut hip, and you will never pass an elderly person again without saying good morning. The good old days.
Wow.
Wow, indeed.
A lot of stuff was lost.
Forever, it seems. You're quite right. It's a serious joke. And if it wasn't so serious, it would be funny. But yeah, you're right. A lot is lost. For sure. Spooky as hell. You know, class, listen. I grew up two sons in a modern contemporary society over the last 30 years. Two of them. And all I did was all those things I told you. That's why I can say it with authority. It works and it is what is required. It's a big old challenge. It takes a lot out of you. But if you don't want to do it, don't have them. Leave them in heaven. True or false?
True.
Okay. But once they come here, I don't want to hear your excuse, but I slipped. I didn't put on the thing. She said she was taking the man. What the
Odd
hell does that
verse.
have to do with the child? See my
Odd
point?
verse.
Yeah, like we keep this crazy stupid thing we have, but she should have wear a flicking thing, and then she do it. I ain't paying no church. All this nonsense we carrying on with, man. My, indeed. Okay, and so I grew them up in a very contemporary society. This one that you guys are in, but what I did was I applied the same old school rules that they taught me, and I can tell you unequivocally, it works. Up to this moment, I have never had a single problem with any of my sons, period. School, church, and the road home, period. Does that mean they're perfect? No, just applying the rules. God does not make mistakes. You cannot be a part-time parent and expect certain results. You cannot be too busy, too tired, too break, too nothing. Because the rules doesn't require those things. You just have to adjust your agenda to do it and be diligent, do it every flicking day. Not when I feel like it, if I'm in the mood, if I'm not out with Mary Jean, if I'm not trying to climb the corporate ladder, whatever the hell it is we say. None of those reasons are acceptable, even though all of those are reasons and excuses we give. And who suffers? The innocent child that we brought. See, I'm back on that crap again. Okay, depreciation. So now that we know what these long-term assets are, we know that they go on the balance sheet at cost. We know that if we purchase them in a group, we have to apply a certain rule to separate the assets so that they can appear on the balance sheet individually. We know all that stuff now. Okay, we know what the characteristics are for long-term assets. So now we get to the final phase for us anyway, which is called depreciation. And depreciation is really just an allocation of the cost of the asset. What does that mean in English? Anybody knows? The allocation of the cost.
Like a spread out of it.
Yeah. So for example, yeah, that's a great way to put it. For example, if you buy a piece of equipment to make shoes and you spend $100,000 for the equipment, you're not going to depreciate the equipment in 1 year because that equipment will be making shoes for you for many years. True or false?
True.
So you estimate then how long we believe, talk to the manufacturer if necessary, say common sense stuff. How long we believe that machine will make shoes for. And if the manufacturer says, we estimated because we made it, that this machine will run without any major problems for 10 years, then what does the accountant say? Great, that 10 years will then become my estimated useful life for accounting. So instead of depreciating the entire $100,000 in 1 year, accountants have come up with the ingenious idea to spread or allocate the depreciation over the useful life, which in this case would be 10 years. That's all. Because every year that equipment is going to be generating revenues, so we allocate the depreciation or the cost of it for the useful life. And what do we call that allocation? Depreciation expense. So every year when we take off depreciation, we reduce the carrying value by the depreciation amount. And every year we write off that depreciation as an expense to show what? that for that year, whatever revenues are generated by that equipment is offset by the depreciation expense necessary to generate that revenue. Because after all, what are expenses? Expenses are what we pay or incur to generate revenues. For example, we have salaries expense only because you have to pay people to sell the product, true or false?
True.
Okay? We pay BEC only because we need the light on so the customers don't have to shop in the dark, otherwise they won't come, correct?
Very true.
Indeed. So expenses really only occur in order for us to generate revenues. So depreciation expense has the same function. It helps the company to generate revenues through allocating the cost of the long-term asset. See how that works? We can make it complicated or we can make it less complicated by simply putting it that way. Okay. Notice we are told that in accounting for depreciation, it is important to keep the following things in mind if you're going to do it right. First of all tangible assets except land, as I said, have a limited useful life. Land is unlimited. Land does not depreciate, so it doesn't have a limited life. It goes on and on and on and on. We break stuff down, build it up on land, keep sitting there forever. Interestingly enough, because it seems basically like anything God creates lasts forever, and anything man creates does what?
All the way.
Yet
Wow.
we say, is there a God? Well, indeed. Everything God creates stays. Everything we create falls apart and depreciates. My. All right, same principle. So land has unlimited useful life. Everything else has limited useful life. And the cost of the assets we are told must be distributed over the years, which we just discussed. Okay? There's physical deterioration with long-term assets. Keep that in mind. Results from the use and wear and tear. And then there's obsolescence. What is obsolescence?
Probably when it don't have no value no more.
Well, it may have value, but has no what? Use.
Yeah, there you go.
Yeah. For example, the old Polaroid camera, it has value. But then has no more use. So it becomes what? Obsolete. And therefore, obsolescence is quite different from physical deterioration. Physical deterioration means wear and tear. Obsolete means you cannot use it, or it is not practical to use it anymore. Going out of date. Going out of date. My. All right. Remember, depreciation is not a process of valuation. It has nothing to do with the valuation of the asset. All it does is allocate the cost of the asset over its useful life so that we can expense it year after year for all the revenues it's going to help to generate, just like salary expense, utilities expense, and any other expense. Okay? So, what are the factors in computing depreciation? The cost of the asset, the residual value, which is what we believe the asset will be worth at the end of its useful life. So if you buy a new car today, and you say this car is going to have a useful life for me of 10 years, and then at the end of 10 years, you plan to sell it for $2,000, then that 2,000 becomes the residual value. What's left in your estimation after the useful life has passed. Okay? Residual value. Then we have what we call the depreciable cost. Anybody knows what that is? Depreciable cost. How is that defined?
The individual The individual, the cost per year, the allocated cost per year that it depreciates.
Okay, so it's the cost of the asset minus what?
The depreciation expense.
Not depreciation, but rather the residual value.
Boom.
Yeah, the formula for depreciable cost is simply the cost of the asset minus the residual value. So if you pay 10,000 and the residual value is 2,000, you subtract 2 from 10, it's 8. That 8 becomes the depreciable cost. In other words, that's the cost that you will actually depreciate year over year. Okay, that's all that is. Okay, and of course, we have already spoken about the estimated useful life. That is estimated by the accountant, by management, based on historical, based on manufacturer's estimates, and so on. All right. So now that gives us a moment to look at one or two depreciation methods. Of course, you'll see depreciation again in part 2, but I really wanted you to understand the nature and characteristics of long-term assets and their importance before you got out of accounting 1, because it's such an integral part of the business process. Without long-term assets, the company would not be able to generate revenues. And if they cannot generate revenues, they cannot generate profits. And if they cannot generate profits, they cannot continue in business, period. That's how it works. Nothing magical at all. Okay. So there are several different methods for calculating depreciation. Either one is acceptable in accounting. Companies choose the one that is most appropriate for them. Does anybody see the methods yet? While I was talking, what are the methods?
One is straight line,
Straight line,
reduction method,
production
and
method,
accelerated method.
the accelerated method, also known as,
Declining balance method.
so that means the same. Anytime you hear accelerated method, it means the same as declining balance. So those, there are one or two other ones like units of production, etc. But those are extended methods. These are the 3 key depreciation methods. Straight line is the simplest of all, as you will see. Simple as sin. See the formula right there? Cost minus what?
Residual value,
Divided by,
estimated useful life.
in this example, depreciation each year will be
3,600.
for how many years?
5 years.
And we multiply 3,600 by 5 years, what do we get?
So damn, 18,000.
What do we call that 18,000 that we just talked about a moment ago?
The depreciable cost.
My. Man, it's hell when you actually focus, think, and learn. It's a beautiful thing, no matter how simple it is. The opposite is also true. When you don't focus or learn, it's a tragic thing. That's why so many of our young men in particular are confused and messed up, because some of them can't even spell rat. And then somebody said, boy, you dumb now, you can't spell rat, man. Then they pull out the gun and shoot the person because they're angry and they don't know how to deal with their anger management. And they're trying to figure out how come they can't spell flicking rat. And it's not their fault. Nobody taught them. Nobody made sure they could. Like, Johnny, sit down. I won't play. I'll cut your hip. Sit down and spell rat again. Okay, M-A-T, that's mad, boy. Spell rat. And you stay with it until he gets it. You can't say, I tired of this little boy gone. How the hell you could say that? And he's only a little child. My. A lot of the damage that we have, we are responsible, not the children. They are the ones who have to live with it. And unfortunately, in many cases, die as a result of it. It's my thing. All right. So that's straight line depreciation. Simple. So next week, if I said calculate straight line depreciation, anybody gets that wrong? I don't know. In the old days, we should say should be shot. We don't really mean for real. It's just an expression.
It's a very
Second
common
method.
question.
So we didn't mean it then. Nowadays they mean it. That's the problem. All right, second method, production method. Simple formula again. Cost minus
Residual value,
divided by,
estimated units of useful life.
where you think the unit gonna come from? They're gonna be given. In this case, the units are what? 90,000 miles for this particular asset. Sounds like a vehicle, right?
Seems so.
Yeah, delivery van. Travel 90 miles. We expect it to have to travel 90,000 miles during its useful life. So we use the 90,000 miles here instead of years. Does everybody see that? That's it. Because it's a vehicle and we're basing it on mileage rather than useful life. That's all. Under the production method. Based solely on use. So if we follow the formula, it works out to be how much per mile?
20 cents.
20 cents per mile. If the truck is driven 20,000 miles in the first year, 30,000 miles in the second year, 10,000 in the third, and 20,000 in the fourth, and 10,000 in the fifth, then once you find out this cents per mile, then you just, it's like a piece of cake after that. So walk in the park. And we'll see that in a moment. But before we go to that particular calculation, just take a look at this chart. What is this a chart of? Have we done this already?
We've done the theory of it.
Well, we did the first year, didn't we?
Yeah.
So for example, this is the depreciation schedule. Notice cost, depreciation, accumulated, carrying value. So at the date of the purchase, the cost is 20,000, no depreciation in the first date. None of that. The carrying value is 20,000. Anybody remembers the formula for carrying value?
Mm. Cost. No, Jed, never mind. But the carry, I know the
Cost,
carry
yeah, cost what? Minus,
end value, residual value.
not residual, cost minus depreciation.
There we go.
Okay. Or accumulated depreciation. We'll see. So end of the first year, notice cost remains the same in every year. Does everybody see that? Year 1 through year 5. Correct?
Seems so.
On your straight line, depreciation is the same for each year, correct?
Okay.
Okay. 3,600. But now things get interesting when we get to the third column, accumulated depreciation. Because annual and accumulated are not the same, true or false?
Yeah, true.
Annual is a single amount, accumulated is what?
Cumulative.
Yes, it is. That same stuff you learn in middle school that is millimeter. How are you trying to make me learn cumulative? And now you're trying to get me to spell it. I'm gonna shoot marbles and then they let Johnny go rather than what? Haul him back in. If you don't spell cumulative, you're not gonna do anything else. Make him learn it. So that when he grows up, he could say, Jesus, I'm so happy they made me, rather than let me go. Hanging out with naughty Johnny, wasting my time. All right, so end of the first year, annual depreciation is 3,600, accumulated is 36. What is the carrying value?
16,400.
How did we get that?
We minus 16,400 from the original cost value.
Well, you didn't know 16,400 until you knew it. How did we get it?
We minus the annual depreciation from the cost value. That still doesn't answer your question.
Well, not entirely. It's correct in this case, but it gets funny when you get in year two.
It's the accumulated depreciation less the carrying value, I guess.
Which one comes first?
What do you mean?
If you take 36 from minus 20,000, you're gonna get a minus answer.
That's
Mhm.
true.
The cost minus depreciation. The accumulated
Yeah.
depreciation.
Well, yeah, the cost in this case, it happens to be 20,000. So it's 20,000 minus accumulated depreciation, which is 3,600 equals 16,400. Okay, carrying value, end of year one. End of year two, annual depreciation is how much?
3,600.
Accumulated,
7,200.
carrying,
20,000 less 7,200, which comes to 12,800.
interesting. 20,000, the carrying value, minus the accumulated depreciation equals 12,800. Let's see if that happens in year three. Annual depreciation,
3,600.
accumulated.
10,800.
Where did that come from?
Okay, it came from the two existing accumulated. I lie. The sum total. Oh, now I see what you're saying. So it's almost like you have to multiply the annual depreciation by the year.
Oh, by the year? By the number
Not,
of years?
not by the year, but the amount of years.
Yes.
That are
So 36 times 3 equals?
10,800.
That's how we get accumulated anything. And that's why you learn your tables.
Boy, oh boy.
See? Anybody in this room know what 7/8 are?
42? I could be wrong.
Dead wrong.
48, 48. I lied.
Hell no.
Yeah.
No.
49.
Uh-uh.
56.
56.
Wow.
Hey,
Yeah,
Mario.
that's
Mario, you on
powerful.
trial.
it's okay.
That was too easy for Mario.
Dog,
He didn't like
dog.
that one. He didn't like that one.
I was talking. I started talking with 10 stuff like grade 11. I'll be lying to y'all.
I know.
Wilkinson, so we're
Aye.
not adding the annual depreciation to the accumulated to get the, okay, I'm trying to, if we add the 36 and the 36 and then the 72 and the 36 and then the 10, 8 and the 36, we keep getting the accumulated depreciation. So what's the formula again?
Oh. The accumulated depreciation in year one is the annual depreciation in year one.
Mhm.
The accumulated depreciation in year two is the annual depreciation in year one and two.
Right, okay, so that's the way.
Yeah, so you can either add or multiply, whichever is easier for
Right.
you.
Okay.
Yes. Okay, that's why I thought I'd ask Mario what 8/8 are.
Yeah, because
Mario, what are 8/8?
8 say Mario.
64?
Good. Now, let me ask you something. You think you just knew that because you all that and a bag of chips? No,
No.
no. Some teacher and or parent drilled that into your bloody head. You don't even remember when you learned it. Correct?
Yeah, I used to be to the back of the book. I remember seeing it
No,
photographed.
no, no, no. I don't want no semantics. You have no idea when you learned it. None. But somebody made sure you knew your tables, right, Mario?
This is
Yeah.
true.
We used to
So
get
that
beaten
guy
every tree for
in
that.
town with the gun. Nobody made sure he knew his table. He could hardly spell his name. And then everybody say, man, big old stupid, you so dumb, boy. Then they start shooting each other. Because nobody even taught them how to deal with their differences because they don't know what that means. You tell them you love them, they don't know what you're talking about because it does not compute. You try to discipline, they will kill you because they don't know the essence of discipline because you cannot discipline adult that way. You have to teach them when, see, that's my point. See, we keep going right back. It's an accumulated in depreciation. My. All right, year 4, annual depreciation,
3,600,
accumulated,
14,400,
okay, which is 3,600 4 times added, or 3,600 times 4 multiplied. Carrying our book value.
5,600.
How did you get it?
That is the accumulated depreciation less the cost, the original cost value.
Less what?
The original cost value. Oh,
Which
the
is?
cost value, I should say.
Which is?
20,000, sorry.
So you subtract 20 from 14 or 14 from 20?
14 from 20.
Okay, because if you do it the other way around, you're gonna get a minus, correct?
That would be true.
Okay. So the carrying value at the end of year 4 is how much?
5,600.
And then in the final year, annual depreciation
3,600.
accumulated,
18,000.
carrying value,
2,000.
which is exactly equal to the. Go back to the formula.
Yeah, but the original computation was an example.
The 2,000 carrying value at the end of year 5 is exactly equal to what?
The residual value.
Thank
Value.
you. Whoever that is, go to the head of the class. Absolutely. Okay, so that's the depreciation schedule for straight line. Now we can go back to production where we calculated that 20 cents per mile, and then we're told in order to calculate the depreciation and the carrying value, we now have to apply that 20 cents. All right, same table, except instead of we have a different additional column called miles. Everybody see that, miles? So the date of purchase is 20,000 again, carrying value at the date of purchase, 20,000. In the first year, again, cost never changes. The number of miles driven in year 1 was how much?
20,000.
Uh-huh. Annual depreciation,
4,000.
how do we get it?
0.20 times 20,000.
Absolutely, way to go. Accumulated depreciation year 1,
4,000.
carrying a book value.
16,000.
And how do we get that?
Take away the accumulated depreciation from the cost.
Or the carrying value in this case?
Sorry, yeah,
Yeah, it's just that cost and carrying value just happen to be the same
same thing.
at the date of purchase. Because remember, the carrying value is not 20,000 at the end of the first year. True?
Because of the residual,
Not the residual. What is the carrying value at the end of year 1?
16,000,
Which is different from the carrying value at the date of purchase.
right, 20,000.
Absolutely. Okay, little subtlety. Year 2, number of miles driven
30,000.
times 20 cents equals
6,000.
accumulated depreciation,
10,000
which is the sum of,
of the 4,000 and the 6,000.
yes, annual depreciation for year 1 and year 2. Carrying value after year 2,
It's 10,000.
and we get that from,
The taken away the accumulated from the carrying value.
absolutely. It's amazing once you learn the rules. Man, it's just like unbelievably smooth once you get the rules down. And when you don't, it's unbelievably bumpy and miserable. All right, year 5. How many miles traveled?
Year 5 is 10,000.
And how do we get the annual depreciation?
16,000 So, yeah, the 16,000 plus the 2,000.
Aha,
Or the annual, my bad. 0.20
Aha.
times 10,000.
way to go. Okay, watch out for the examiners like to throw little spokes every now and then to see if you're staying focused. All right, and your accumulated depreciation in year 5,
18,000.
how do you get that?
That's the 16,000 from the previous year and the 2,000 from the current year.
So that's another way to look at it. 16 from the previous, 2 from the current. Or you can go the long way, 4 plus 6 plus 2, right? Of
Mm-hmm.
annual depreciation. Either one will give you the same answer, whatever works for you. And the carrying value at the end of year 5,
2,000
which is exactly equal to?
residual value.
Absolutely. All right. So that's 2 methods, straight line and production. The final one that I want to walk you through, and then we're done. I won't take you beyond that point, is the double declining method or the accelerating method. Not, some people call it double declining. We'll call it declining balance method or the accelerated method. Okay? Very simple. Well, I shouldn't say that yet. If you notice the data in our example of the straight line method, the delivery truck had an estimated useful life of 5 years. And the annual depreciation rate for the truck was therefore 20%, which is 100% divided by 5 years. In case you were wondering how we got to 20%. Under the double declining balance method, the fixed rate would be 40%. Always, which is 2 times 20, double 2 times 20, which is the 20%. Now, for your purposes, usually you'll be given the double declining rate, which is 40% here. But we show you how it's derived if another discussion comes up, like for example, in this case, the estimated useful life is 5 years. What is the rate? 100% divided by 5 years, which is 20% per year. What is the double declining rate? 20% times 2, because 2 is double. Normally though, the 40% double declining rate will be given to you. Okay?
Question before you
Yes.
move on. Okay, so you say double declining is 20 times 2. Is there any incident where it can be just declining, where it be the 20%? Or it has to be double declining, which would be the 20
No,
times.
it can be non-double. For example, in your example with straight line, we say the depreciation is 20% per year, single, correct? Not
Okay,
double.
okay,
So 20% of 20,000 is how much?
2,000.
Okay.
4,000, my bad.
Oh, 4,000, right? Such that over 5 years, it will be 4 times 5,
20,000.
which is the cost of the asset, correct?
Yeah,
So yeah, it doesn't have to be double declining. It can be single, as in the case of annual depreciation of 20%. Double declining is just another method where we take the annual rate multiplied by 2, so we can have what we call an accelerated or faster moving depreciation. And again,
okay.
this method is used by certain companies for certain reasons. That's why it has been made available. Remember, you can choose either of the 3. At the end of the day, the asset is still what? Fully depreciated. You follow?
Yes.
Yes. So in straight line, you depreciate it evenly each year. In production, you use the mileage because you're depreciating a vehicle and it's moving. The mileage represents the life on the engine, which determines its useful life. And then in double declining, you'll see soon why this method exists. Okay. Again, the usual columns. Date of purchase and carrying value. We're experts on that now. End of the first year. Double declining. Annual depreciation is how much? Anyone?
8,000.
How do we get it?
40% of 20,000.
40% of 20,000. Accumulated depreciation,
8,000.
carrying value or book value.
12,000.
Is carrying value and book value the same in accounting?
They are.
Okay, so let me get you that next week. End of the second year, annual depreciation,
40,000 of 12,000. Sorry, 40% of 12,000.
what 12,000 is that?
The 12,000. I mean, I look at you say annual depreciation, right?
Yeah, you said 40% of 12,000, that's where the 12,000 come from.
Okay, the 12,000 is the previous annual depreciation less the cost value.
That will further complicate it. I suggest you just say the 12,000 is the carrying value from the previous year. How's that?
Oh boy. You see that? Did you say that?
Save yourself a lot of stress and the rest of your colleagues as well, trying, even though what you said was correct.
Boy.
Okay. All right, the 40% of 12,000 is 40% of the previous year's carrying value. Okay, and that equals
4,800.
accumulated depreciation.
12,800.
Where did that come from?
That comes from the previous. Let me see. I'm trying to complicate it more, but that comes.
But don't let that cause you to not answer.
that comes from the annual depreciation plus the previous accumulated depreciation.
What are you trying to determine again?
Where the 12,000
My question was where the 12,800 came from?
That's the
Yes,
accumulated depreciation plus the annual depreciation.
Accumulated depreciation plus annual. Okay, that's another, okay, 8 plus 4,008, you mean?
Yeah.
Okay.
I guess
Okay.
I'm carrying value. It's not being
No,
wrong.
if that works for you, that's fine.
So what's the
else
more
might-
simple version?
Somebody else might say it's depreciation from year 1 plus depreciation from year 2 and call it that. All right, so your accumulated depreciation is 12,008. What is your carrying value at the end of year 2?
7,200.
And where did that come from?
The accumulated depreciation less cost value.
That's
I
cost
lied.
value?
Cost value less accumulated depreciation.
What do you mean by cost value?
The how much they
Carrying
pay
value.
for.
Carrying value.
Boy, oh boy.
The carrying value, get used to saying carrying value minus accumulated depreciation equals 7,200. All right,
I'll get
yes, you will. Year 3, 40% out,
7,200
which is the,
carrying value.
from which year?
Previous year.
Yeah, because if you just say carrying value, you have several of them, even though we know what you mean. Which equals?
2,800. 2,880.
Accumulated depreciation,
15,680.
book value,
4,320.
notice I'm not saying the usual stuff anymore because I'm assuming you guys are now professionals of this nonsense. End of year 4, 40% out,
4,320.
which equals an annual depreciation of,
1,728.
and an accumulated depreciation of,
17,408.
and a book value of,
2,592.
Now it gets interesting. At the end of the 5th year, the annual depreciation is equal to,
The residual value less.
no, not the formula, just the amount. The annual depreciation is equal to,
592.
interesting. And the carrying value,
2000.
which is exactly equal to,
The residual value.
so what have you determined with double declining at the end of the 5th year? Why is depreciation only 592?
Because that's the only amount left that would equal, that would bring you to the carrying value.
That would bring us to
After
the
you took-
residual value of,
2000 residual value, sorry.
yes.
Wow,
Notice
not
a
my,
little note. Notice a little note at the bottom. Anybody read that asterisk? Depreciation is limited in the 5th year to the amount necessary to reduce carrying value to the residual value, i.e. 2,592 from the previous carrying value minus the residual value of 2,000 leaves a depreciation of 592 only for the 5th year. Another rule. Okay. And that is your double declining. Have you noticed anything interesting about the annual depreciation and the accumulated depreciation under double declining? But let's say annual depreciation. What is happening under double declining to annual depreciation?
it's always computed. It's computed. A new computation comes out each year.
Using the
we-
carrying value.
Well,
Dread.
the carrying value, yeah. All of them are computed each year. But look at the numbers in annual depreciation. Did you see a trend in the numbers?
Carrying value, as she said.
Well, don't you see that the annual depreciation is greater in the earlier years than in the later years?
Yes.
As opposed to straight line is not greater, it's the same. Each year, right? Annual depreciation.
True.
8,600, right? See right here. Under straight line, annual depreciation is the same. Under double declining, annual depreciation is greater in the earlier years than in the later years, true?
Yes.
True.
And the reason why companies like to use this is because in the early years, they take off a greater amount of expense, which produces less profit, and they pay less taxes. That makes sense to anybody yet? Or you have to wait till you get to accounting too for that to kick in?
But like, let me ask this question, right? When they use these different methods to create statements that show a low net income, does I don't want to say they cook in the books or they like doing false representation, but if, let me ask you this question, then is that net income equal to the amount that stays into the account at the end of the year?
Some of it will stay, some of it might be paid in dividends. But the point is this: if they use the double declining and take off a great amount of depreciation and come up with less net profit and pay less taxes, that's only in year 1 and 2. Notice as we get down to the end, you have less depreciation. So profits are going to be more, so you pay more. At the end of the day, it balances out. That's the point. Over the life of the asset, it still balances out. If you pay less taxes in the early years, you pay more taxes in the what?
Later.
Later years. So at the end of the day, you still pay the same amount of taxes. You just have cash flows are different. If a company wants more money in the early year, then they use double declining to pay less taxes. If the company wants less, see my point? So it varies depending on the objective of management. Okay. For you, as the accounting students, which one to choose is not your problem at this stage. You will figure that out later on if you become part of some management team to make a decision. For next week, just make sure you can do the mechanics. Because at this stage of the game, fundamentals of accounting 1, you're not into the analytical side of management decision making. You're into just learning the what? Mechanics. How to do it. And to some
The
extent,
rules.
yes, the rules. Because if you don't learn the rules, later on you're gonna mess things up. One way or the other, for sure. Okay? I don't know if I told you, my baby hated English. He hated writing compositions, essays, answering comprehensive questions. He hated spelling tests. Because see, part of him was very artistic. He used to like drawing and play the piano and stuff. So you don't sit down and mess around with academia like most artists are. Most artists hate academics with a passion because they just want to freaking sing, dance, play the piano, play some instrument, paint something, sculpture something, that kind of stuff. But even though they might hate it, you still have to make sure they learn the basics, fundamentals, so they don't end up stuck. So he hated that stuff. He used to be under the table crying in primary school. Oh, you don't want to do it. When he gave me his essay, draw kind of lines through it, fix it, change that, spell that. He was mad at me straight through primary school and partly through high school. Now he's writing me all kinds of notes and writing, Dad, when I consider the circumstances surrounding our discussion, I said, who the hell teach you how to read and write that? Weren't you the one that hated English? He laughed. He said, it's a good thing you stuck with it, Dad. Because he knew I wouldn't let him off the flicking hook. And that's really what I'm saying. I'm not talking about some textbook. I'm talking about what I know. So those of you parents and parents to be in this group and little young punks like Mario who will be a dad one day, don't fool around with that responsibility to your children. Remember, I told you that. You will be doing them a great injustice. If you don't want to be bothered with the responsibility, leave them in heaven. Oh, back on that again. All right. I see Hervanique. Hervanique, how long have you been with us? Hervanique.
I think she may be the one with the mic issue.
Hi. No,
Hi,
like,
Hervanique.
like
How long have you been with us?
from the beginning of the class.
How come you didn't say anything when I called the register earlier?